are you able to see the screen?
Yes, ma'am.
Okay.
मय सर्वेषां स्वस्तिर्भवतु सर्वेषां शान्तिर्भवतु सर्वेषां पूर्णं भवतु सर्वेषां मङ्गलं भवतु लोकाः समस्ताः सुखिनो भवन्तु ॐ शान्ति शान्ति शान्तिः
Not able to hear anything.
असतो मा सद्गमय तमसो मा ज्योतिर्गमय मृत्योर्मा अमृतङ्गमय सर्वेषां स्वस्तिर्भवतु सर्वेषां शान्तिर्भवतु सर्वेषां पूर्णं भवतु सर्वेषां मङ्गलं भवतु लोकाः समस्ताः सुखिनो भवन्तु ॐ शान्ति शान्ति शान्तिः
Students, are you there? Are you able to hear whatever I'm speaking? What
Yes,
happened?
ma'am. We're able to hear you, ma'am. Not the video.
Okay, were you able to see at least? Were you able to see the screen?
Yes,
Yes.
ma'am.
Yes, ma'am.
Yes. Okay. Invoking the blessings of Almighty is always a must. Okay. So all of you kindly mute yourself so that we can begin the session invoking the blessings of Almighty. Okay. So do tell me whenever you are not able to see the screen or when I'm not audible. Is that clear? Okay. So let us go for day 2's division. Okay. We are now in the rapid revision day 2. So what is that we are going to see actually? That's what you're going to now see. What are we going to see now? Okay, in today's revision, what is that we are going to see will be listed out to you. The topics to be covered. So welcome to day 2 session in economics. And as we completed considerable portion yesterday, there's also a lot of hope and confidence that today too we'll be able to do whatever we targeted, right? So I think yesterday we did a pretty lot, starting with the nature and scope of general economics, business economics. There we did a lot of segments for our study, and then we went on to, I think we also did demand analysis, law of DMU, and we also did, what is that? I think elasticity of demand almost we completed. We were just go through the numerical examples, isn't it, students? We were go through the numerical examples, if I'm right. Should we start there?
I'm not able to see the screen.
Not able to see the screen? Okay. Okay, so what is the look at the thing what we are going to do today, that is very important for you. Okay, so today is day 2 of our revision, isn't it? So what you have to do is, in the revision session, try to be very meticulous, listen to everything which is being given, because it has an exam orientation. Okay, and jot down the core points, because here and there template questions or format questions would be given to you, and those which you have to clearly focus has been given. And don't keep muting others or disturbing others. Stay till the end of the session so that you grasp all the contents, because the next day we may not go into that. Okay, we don't have time, because of the lack of time we are not able to go into that. Okay, so that's another thing you have to know. And regarding the digital platform, please try not to have your background thing, on, so that others may also be disturbed because of that. Okay, so what are the topics we are going to see today? Okay, today's takeaways are, so undone portion of yesterday, like numerical example from elasticity of demand. And in supply theory, literally the concept of supply we are going to see only from MCQ's point of view. And in elasticity of supply, you are going to recollect the formulaic expressions, schedule and graphical representation. And theory of cost, a very important uh, topic from the examination point of view. And as well as this is considered to be theory of cost and revenue are said to be prelude topics to the market structure, which is a vital segment of the subject, right? So the theory of cost and theory of supply, they are not only important from the topic perspective as such, but for the next topic, market structures, this is the prelude, or these two topics are the prelude. So we will also be covering market structures, and last but not the least, we will have a quick go through of the topic economies of scale. Okay, so have you seen, is the screen visible? Do you see what we are going to target today? So with your cooperation, let us do that. Okay, so let me go on to this. Yeah, so in elasticity of demand, what was the thing we wanted to do? We were in, I think, numerical example 1 we revised, and I also told you what's important in the topic from MCQs. Okay, what is that? What the first part, what we saw, who gave the concept of elasticity of demand, and from then on, right? So let us see the core points. Okay, so learnings from the lesson. If you just look at the topic, you have something called as learnings from the lesson. So what is that I'm doing in this learnings from the lesson? So I'm going to understand the core components or core segments within the topic. So the concept of elasticity itself has its various explanations, and major types and subtypes, formulaic expressions, methods of measurement of elasticity, right? So I think we had a quick glimpse of all this yesterday itself. So let us go on to the numerical example part. So let us go on to the numerical example part. I'm sure you understood how you will be reading price elasticity, how you would study income elasticity with examples as such, and also the diagrammatic representation of cross elasticity, which is a two commodity model. So this is the first example we saw yesterday. Go to the second one. So here what is happening, the same thing, price elasticity of demand, we are having numbers instead of percentage, we are having the demand, applying the formula. So if the price of good X falls from rupees 6 to 4 per unit and the quantity demanded goes up from 10 to 15 units, compute coefficient of price elasticity. Applying the formula which we already studied, delta Q by delta P into P by Q, we will get the answer. 5 by 2 into 6 by 10, which is minus 1.5, and already we know this minus sign connotes the inverse relationship between price and quantity demanded. So we are not going to see this as a mathematical sign. We are going to bring it to our mind or recollect that it is an economist rationale. Okay, so have that point in mind. Now that is regarding the percentage method or the general formula for computing price elasticity of demand. Then we have something called as total outlay method or total expenditure method. So what is this total outlay method? This again is a method which was suggested by Alfred Marshall for computing price elasticity of demand. Okay, so what is the difference between this method and the general method which we saw here? The degree of responsiveness of demand is taken here as changes in total expenditure to changes in price. Okay, so we are not taking into account the quantity demanded as such. We are taking into account the response of the total expenditure or total outlay in purchasing that quantity demanded to changes in price. Okay, so be clear, students. Look at this small tabulation. You have a small table which tells you that. Look at this table. So what's important for us is this column. So we are having 3 demand schedules. You know how we compute, how do we do in total expenditure method. So we have taken 3 different market schedule 1, 2 and 3, and you find that in each of the market schedule the price is coming down, and in keeping with the law of demand, you find the quantity demanded is increasing. Okay, we find quantity demanded is certainly increasing, and here what are we computing? We are computing quantity demanded at the respective price. We are multiplying the quantity demanded with the prevailing price per unit, and we are getting this third column. Now looking at this column, elasticity is determined. So when you find total expenditure increasing, it will be E greater than 1, which you call as elastic demand. When you find total expenditure constant, you call it as E equal to 1, which is unitary elasticity. And when you find your total expenditure declining, you call it as inelastic demand, where E is less than 1. Okay, so this is just a quick revision, but I'm sure you would have understood the backdrop of this table. Okay, and now in the examination, you will not be generally given a sum on this. That's not been there in the previous thing, but what is total expenditure method is done here, right? Now coming to the diagrammatic representation of it, look at this, the same thing. So the E greater than 1 is this portion, E equal to 1 is this portion, and E less than 1 is this portion, right? So if you make a tentative graph of the total expenditure method of computing price elasticity of demand, you will get this. Now what kind of question is possible here is the degree of responsiveness of dash to changes in price. So that dash defines this. The degree of responsiveness of the changes in total expenditure rather than quantity demanded. You replace that quantity demanded with total expenditure. Okay, how much do a consumer or does a consumer has to spend to buy the quantity which he wants at the prevailing price? So you are given a prevailing price and you know the quantity demanded, you are calculating it at a price of rupees 6 per unit. If 1000 units were demanded, what is the total expenditure? Now this will determine the elasticity. So the degree of responsiveness of total expenditure or outlay to changes in price is measured here. Okay students, so please remember that part very clearly. Okay, then coming to the next important method, point method. Please note it, jot this down as an important question. Point method is otherwise known as geometrical method. See, usually they will give you this method is also known as geometrical method. You will have total expenditure method, point method, arc method, everything coming. So people may tick mark arc method because that also is geometrical, right? So please understand that point method is otherwise known as geometrical method, very important. Okay, this again is one of the methods of measuring price elasticity of demand. We are now in the types of price elasticity of demand with numerical examples. So solutions are also there, formulas are there. So now look at this point elasticity. So what is the formulaic expression? The formula for measuring elasticity at any point on the demand curve is lower segment by upper segment. Now take this simple example. No? So we want to measure elasticity at point P. So what is the answer now? Lower segment. What is lower segment? This is the lower segment. The segment which is below this point is lower segment. So which is Pn divided by upper segment. What is upper segment? That which is above the point P, which is Pm. So Pn by Pm will give you the elasticity of demand at point P. Now from the examination point of view, this diagram may be given and they may give points like this, and in the respective point they will ask you what is the elasticity. For example, they may give this chart. If they give a chart like this and they say what is elasticity at point A, and there will be 4 options. Elasticity of demand is equal to infinity, it is greater than 1, it is equal to 1, it is less than 1. So we will write it is greater than 1 because at point it is greater than 1. So we all know that at this point on the x-axis, ED is equal to 0. Likewise, at this point on the y-axis, ED is infinite. And the midpoint is where you have unitary elasticity of demand, where ED is equal to 1. So above this and below this you have ED greater than 1, and above 0 and below 1 you have ED less than 1. So jot this of repeated question. So any point they may give, probably at point M, they may ask you at point B, so you may have to give. Okay, and also make a note of this formula. Right, now arc method. Now students, 2 important methods which are usually asked is like a sum, like a numerical sum or example is one is generally computing the price elasticity of demand, as we saw above, a little while ago. What we saw, this one, like this, like
Can you show the formula of this
which one, which one?
arc method formula?
Arc method, yeah, sure, I'll show you that. Yeah, this one, this is arc method. No, original quantity minus new quantity divided by original quantity plus new quantity, whole thing divided by original price minus new price
Yes, ma'am.
divided by original price plus new price. So
Yes.
look at the symbolic representation also. Okay, both are given in words and in symbols. So for you to know this notations, probably they any notation can be given. That's why in words also I put it. So in the examination, when you're preparing, study it in words, so that when you do, when you are doing the rough work on the sum, it will be easy for you. It's not a descriptive paper, but to find out the answer anyway you have to work out the sum, right? So, and often they ask, supposing if they want you to use arc method, so they will give you in column using arc method, compute price elasticity of demand using arc method. If they don't give using arc method, you can use that example one, no, same, the original, the usual formulaic method, no, general method of computing price elasticity is this one. Example 1 and 2. Normally we have delta Q by delta P into P by Q, the same thing. So this is for the normal, either in percentage form or in numbers they can give. But here you have arc method as such. It's also asked repeatedly. So look at this formula for arc method in words. You have to remember that. This is
Ma'am, could you?
Ma'am, one
yes,
doubt.
yes. Yeah.
Ma'am, elasticity of demand is always negative, no, no?
Price
But in
elasticity of demand. Price
price
elasticity.
price elasticity of demand is always negative, no, ma'am?
Perfect,
In
yes.
if I'm in MCQs, if they give both the negative answer and the positive answer, what should be right?
Negative, negative, negative,
Negative.
negative,
Okay.
negative. Okay, so if they are giving, economists ignore the sign because every time it's positive, every time it's negative and it shows inverse relationship, it's not mathematical sign. But if you get minus and plus, please tick mark minus.
Yes, ma'am.
Okay, okay. So now when you say arc method, actually supposing they give you like this, if you want to measure elasticity, arc method, if you have a diagram like this, you can understand this is how, no? Measuring elasticity between 2 points. In arc method, what are we doing? In the point method, we found out elasticity at a point. Point M, point A. What is the elasticity at point M? What is the elasticity at point A? What's the elasticity at point B, etc. Okay. So in arc method, it is elasticity between 2 points. Okay. Here you have point A, point B. Just a minute, students. 1 second. இல்லை இல்லை இது இல்லாமல் எனக்கு வராது, எனக்கு நான் எப்படி இப்போ தள்ளுவேன்? ஆமாம் ஆமாம், உடனே வந்துடுவீங்களா? கொஞ்சம் லேட் ஆகாதீங்க சார் ப்ளீஸ், எனக்கு மவுஸ் இல்லாமல் வர மாட்டேன். இது எனக்கு பர்சனலுக்காக நான் தான் So understand this point clearly, okay? So this is what you have to know. Elasticity between, it's elasticity of demand is measuring elasticity between 2 points. That's the meaning of arc method. Okay, yes. Now let us go on to this form. Remember, I am using the formula and working out the numerical example. Look at this numerical example. So P1, what is your P1? So if you go back, you will know whether it is original quantity or new quantity. No? So look at the formula has been given below it, and using the numbers given, the data for P1 is given, P2, Q1, Q2, you know what data, what P1 implies, what P2 implies, what Q1 implies, and what Q2 implies. Okay, so then we have the solution given. So go through this solution and you will know, applying the formula, you will be getting the answer. Okay, and look at the sign added, minus 1.8, because it is arc method is used for computation of price elasticity of demand. So we find out what we do here: difference between the original quantity and new quantity, difference between the original price and the new price, and you get your the number, put into the formulas and then worked out. Okay students, now this is what is an important problem from the examination point of view. Okay, see, if you just know one model of each, it's more than enough, because they are either asking the price elasticity of method in general, the example 1 or 2, or they are asking using arc method. That's the only thing repeatedly asked. So total expenditure outlay method, they never ask the chart and all. Maybe some question on theory part of it they are asking, but they are not asking you to compute the components of the table. So far they have not asked, but I have shown you how it is computed. All the 4 columns, market schedules have been given to show how the computation is. In case if you get a theory question on that, you can attend. Okay, so what I'm saying to you is total expenditure method or total outlay method, it could be a theory question. Okay, otherwise as a problem, as a numerical example or a sum, arc method and general method of computing price elasticity of demand is repeatedly asked. Okay students, yes, are you clear? Now I'm going to ask you one question in example 1, in example 2. Let me see whether you are able to tell me that. I just wanted to ensure that you have understood, that you have taken that correctly. Okay students, now look at the example 2. For the P and Q, will you take the original P and Q or the new P and Q? Tell me. This is a general method, general formula for computing price elasticity of demand. Okay, unless they are asking you specifically using arc method, this is the one you have to use. Okay, now just tell me this. Okay, quickly we have to move on. What will you take for P and Q? Oh my god, am I audible?
Ma'am, your screen is stuck, ma'am. You can't see anything like that. You can see only the arc elasticity diagram. That's it, ma'am.
Is it? What happened here? What is happening? I don't even understand what is happening. It's showing that the screen is getting shared. What is happening again?
Ma'am, we can only see that elasticity diagram, ma'am.
Okay, I will then share again. Okay, don't worry. Again, I will go in and share it for you. Technology, you see, is as difficult as economics, no? Are you able to see now at least?
Yes, ma'am.
Yeah?
Yes, ma'am.
So, what I was asking is in example 2. Now, in this only I am asking, for P and Q, will you take the original P and Q or the new P and Q? In case of arc method, you will not have the dot because both has to be taken. Now, in case of the general method, when they ask calculate price elasticity of demand or calculate coefficient of price elasticity of demand, it means not arc method but this formula method. Now, what P and Q you will use?
Original, ma'am.
Original. So, shall we release the example? Okay. So, look at the example. So, what are we using? We have to use the original one. Look at what we have used. 6 and 10. 6 is the original price, isn't it? Price falls from 6 to 4. And what is the original quantity? Demand goes up from 10 to 15. So, note it as original, students. Very good answer from one of the students. So, please note it. You will be using only. See, sometimes people get, they forget. It's not that they don't know, but there is, in all probability, you may forget that. So, you will be using the original price and quantity here. Okay, but if it is arc method, no problem, because we have to take all factors into account: original quantity, new quantity, original price, new price, etc. Is that clear, students? So that's the thing which I wanted to tell you here very much. Now, yes, let us go on to the income elasticity. Now, please don't worry for income elasticity. It is very similar to your price elasticity. So, why is it? Where is the change? The change is there only in this part of the formula. So, for price elasticity, we said delta Q by Q divided by delta P by P. Okay. In income elasticity of demand, we are just going to say delta Q by Q divided by delta Y by Y, where Y stands for income. So no worries. So if you are practicing this sum, so you are practicing again price elasticity similarly to that. Okay. So where lies the change? Only in this part. So we are taking here the degree of responsiveness of quantity demanded to changes in income. So that is how the problem is. Okay. So no worries in income elasticity. You will not have much issues. Now substitutes and components. This is coming under cross elasticity. So please understand here there are two commodities. So what is the challenge here? The first step is you have to know what is, you have to identify which commodity will be taken as X commodity, which means the quantity of which will be taken, which is to be seen as Y commodity. So for the commodity which has two quantities given, you will have as X commodity, and for the commodity where two prices are given, you will have it as Y commodity. Are you understanding, students? And one important, look at this part, jot down this. Substitutes will have a positive sign indicating the direct relationship. Complements will have a negative sign indicating inverse relationship. So there is a possibility of positive sign also in cross elasticity of demand. Look at it. Substitutes will have a positive sign because we already saw, isn't it? When the price of coffee is going up, quantity demanded of tea will increase. Okay, but what happens in case of complements? If the price of ink is going up, then the demand for ink will not only come down, demand for fountain pens will also come down, right? So here you are going to show the inverse relationship. Is that clear, students? Are you able to get that very clearly? So that is one point. Now, why do we say that this quantity and all is very important? See, they may give you statements like this. price of 1 kg. To begin with, they may add 2 or 3 statements which may be tricky or which may mislead you in identifying the X commodity and Y commodity. Okay, so for example, I wanted to find out what is X and what is Y here, and I've identified X as tea and Y as coffee. But when you look at the starting of this problem, there is a statement saying the price of 1 kg of tea is rupees 30. So in all probability, immediately seeing price, what will you do? You are likely to give it as Y commodity. It's not so. So read the entire example. So at this price, 5 kgs of tea is demanded. If the price of coffee rises from 25 rupees to 35 rupees, so coffee has two prices. So coffee will be my Y commodity. Identify like that. So, and look at this. The quantity demanded of tea rises from 5 kgs to 8 kgs. So you have changes in the quantity demanded of tea, and therefore tea will be your X commodity, the numerator commodity, where two quantities for tea are there, and in your Y commodity will be coffee, where two prices for coffee are there. Are you understanding, students? Are you able to understand what I'm trying to say? Did you get it?
Yes, ma'am.
Yes, ma'am.
Yes, students, am I audible? Are you able to get it?
Yes, ma'am.
Yes, ma'am.
Very good. Okay, then let's move on. So that much if you know in this, it's enough. Okay, so both for substitutes and complements, examples have been worked out, and what is important in this has been highlighted, identifying the commodity. So please make a note of as you're jotting down in this revision session. As I tell you, jot it down, please do it, because it is basically from the examination point of view what you should not miss, at least during your revision. When you sit for your revision, you have these things in mind. So under computation of cross elasticity of demand, the identification of the commodity is very important. I find many students, in fact in our class test also, they used to mix up this X and Y commodity. So try to be very cautious about that. Okay, so that apart, the other thing is done. Okay, so shall we move on to the next topic now?
Yes, ma'am.
Come, we will start what is called as supply. Okay, let's go to the supply commodity. We will close this and we will start this. Okay, yes, come on. So in supply what are the learnings from this lesson? That is what you have to know. What are the essential learnings from this lesson? Meaning of supply itself is an objective type exercise. Okay, and law of supply, again, formulaic expression, schedule and graphical representation, because that will tell you the relationship between price and the quantity supplied. So that's very important. And of course, elasticity of supply, you are not asked regularly questions on what to
Ma'am,
say. Yes,
we didn't do demand forecasting, ma'am. What about that, ma'am?
it is there no, in the last topic. That's what I've done. No, selected portions, selected
Oh,
portions that will come separately. That need not be brought here under demand forecasting. Demand, elasticity of demand, supply, elasticity of supply, we have to go in that order. In the last topic, I'll be doing demand forecasting. It's there, done. It's in the selected portions, that segment. Okay, yes, clear?
yes, ma'am.
Okay, so let us go on to the supply and elasticity of supply quickly. Come on. So look at this. Please look at this particular thing given in red. So far what we did under demand analysis is consumer's perspective. Okay. In supply analysis, our focus will be producer's perspective. So we will be studying the decision and behavior of the supplier, just as we studied decision and behavior of the consumer in demand analysis. Okay, it's totally going to be producer's perspective, and this is quite important for you. Okay, so that when you do the factors determining elasticity of supply and supply, if you register in mind that it is about producer's perspective, your answers will be correct. So remember, this point was given in red is a cue to answering questions on supply. Please note that down, because you are not going to think from consumer's angle, because consumer's angle, it was need driven followed by price driven. Here it is profit driven. So producer's analysis or producer's perspective is basically profit driven. Is that clear? So note that thing in red, very important. So look at the objective type exercise. Even here also we have worked out the MCQs as a true or false. Answers are given, and rationale for true or false is also added. And one repeated question is the meaning of supply itself is subjected to a lot of questions. Okay, so whether supply refers to total stock of goods in existence? No, it is not, because remember, in economics, the meaning of the term supply is it is an offer for sale. As simple as that. It need not be sold. It's an offer for sale. It is seen as an offer for sale. So this point B enables you to understand everything. To tell you the whole sum and substance of the term supply in economics or from economics perspective is clear here. Right? Okay, that is it is offered for sale. Okay, and when you look at the definition, similarly, what the producers are willing and able to offer in the market at various prices during a given period of time, it's similar to demand. So that's why I was telling, once you do demand analysis along with elasticity, supply becomes a kind of a revision topic. So please remember the point, it's an offer for sale of repeated question. So it is not a total stock of goods in existence, and it is what the producer or the supplier or the businessman offers for sale in the market. Okay, and what's the supply schedule? That which shows the various amount of the product which a producer is willing to and able to produce and make available for sale in the market at specific price. Okay, during a given period of time. So here remember, supply is also flow concept, because supply is also with reference to a period of time. So offer for sale and flow concept, register it. So jot it down as very important point. So once you know this, you'll be able to easily do the other parts. And one important thing, once this was asked, supply depends on what? Just as demand depends on usefulness or utility concept, supply depends on scarcity phenomenon. Okay, basically we are talking about the goods, the manufacturing or the production of goods is dependent upon the availability of the raw materials. Is that clear, students? So that is what we are trying to see. And basically the law of supply or supply itself, how do we study the supply schedule and all, as a relationship between price and quantity supply. Okay, so do you understand that? Yes. And coming to the determinants of the supply. So this is where I said supplier's perspective has to be had in mind. Profit driven. Okay, so don't go by need driven criteria, go by profit driven criteria. Is that clear, students? So this is what I was trying to tell you all along. So whether it is going to be profitable for him is the only criteria. Okay, so supposing you want to take one of the examples. So let us say government policy, often asked, So taxes, when there is a rise in the tax, the incentive to supply will come down naturally for the producer. If it is subsidy, because the government is going to participate in the financial burden of the supplier, naturally its incentive to supply more will be there. Okay, so nature of competition, size of industry, expectation about future prices. So all this can be answered having in mind supplier's perspective as profit driven. That one key word is important. So far you have not noted down offer for sale. Supply in economics is offer for sale, and it is a flow concept. And while understanding factors determining supply or even determinants of elasticity of supply, profit driven nature is going to be had in mind. Is that clear, students? And in law of supply, we know, other things remaining constant is also there. Ceteris paribus, what we learned yesterday. Yeah, and it shows a direct relationship between price and the quantity supplied. Now look at this slide. Why was this inserted? This is a template question. So whether it is law of demand or law of supply, they will give you four sentences on the law and ask you to identify the correct one or the incorrect one. Please jot it down. This is the fourth question. You're jotting it down. Now in today's revision on the supply concept, they will give something like this. Four sentences asking you to identify correct or incorrect. Okay, so these three are helpful in that manner. That's why repeatedly I've been saying this. So right and wrong statement itself is a template question in both the law of demand and supply of law of demand and law of supply. Okay, is that clear, students? Yes, then let us quickly go, and you have your formulaic expression here. What are we talking about? The algebraic expression of law of supply. Quantity supplied is a function of all these variables, no? What we said as except the price of the commodity in question, others will be ceteris paribus as far as the law of supply is concerned. But what are the factors determining supply? You have price of the commodity, price of the related goods, state of technology, price of inputs, government policy, natural factors, and goal of firm. So those you will be in case you're asked a question from producer's perspective. Okay, so look at your supply schedule. What is the schedule? Meaning of the term schedule, have in mind. Simple question, don't leave it. Okay, schedule implies tabular representation, as simple as that. Okay, so it shows a relationship between price and quantity supplied, which is direct. Okay, so as the prices are rising, supply will be going up, right? And that is why you have an upward sloping supply curve. So don't make a mistake. These are all simple and direct questions. So as far as possible, try to do them earliest. You can for the complicated or tricky questions, you can take time. So demand curve will be downward sloping, supply curve will be upward sloping in nature. Now change in supply and change in quantity supply. Did we do something like this yesterday also in our revision segment? Did we do? Yes or no?
Yes, ma'am. Change in demand and change in quantity.
Very good, Priya. We have done yesterday, right? Change in demand and change in quantity demand. So students, be very careful. This diagram question will appear to be simple, but unless you keenly observe the arrow mark, you cannot address the question, because just looking at the diagram, it's not enough. Many times they give you arrow marks like this. So
Ma'am, this is change in quantity supplied, no, ma'am?
change in quantity supplied. Yes, very
Yes,
good.
okay.
Fantastic. Now tell me whether this is increase in supply or decline in supply. I mean increase, I'll give you four options: increase in supply, decrease in supply, contraction of supply, expansion of supply, or extension of supply. What is the right answer for this diagram?
Expansion of supply.
Is it Salsa who's giving the answer?
Yes, ma'am.
Am I right? Yes, very good. So it is extension of supply. Okay, so look at this. Why is it extension? Because supply is increasing. It's not because price is increasing. We have to look at this. Supply is increasing. So when the price is increasing, supply is increasing. Why should it increase? Producer's analysis. Remember, profit perspective, profit driven. The profit driven producer or supplier will be motivated by rising price. Rising prices, rise in quantity supply. Clear, students? So movement along the supply curve. So revise this. Once you do demand, automatically you must be able to answer this. Is that clear? Okay. Yes. So we will move on. Yeah. Look at the answer. So look at this movement along this same curve. Okay, extension is given, contraction is given. So please be very careful what the direction of this arrow, and then answer. Okay, otherwise you might make a mistake. Okay, you might make a mistake. I'm not saying you will make a mistake. So look at the various ways in which the diagram can be given. They can give in the same curve, the shifts they can show separately, they can show, so different ways. Now look at this and tell me that from SS to S2, What is the option? Extension, contraction, increase, decrease from SS to S2 S2. It's a question to you.
Increase.
Increase. Very good. Increase 100% from SS to S2 S2. 100%. Are you correct? How confident are you?
Decrease in supply, ma'am.
Ma'am, SS to ST is decrease.
Decrease in supply. See, I told you, no, there could be a mistake. Look at this. Because as we go towards the right, you will have an increase. Look at this, from 5 to 6, that is increase. SS to S1 S1 is an increase, whereas from SS to S2 S2, yeah, people do make a mistake because this curve is looking like this, no, as though it is upward, it's looking at it, though it is on the same level, it looks to be an increase, but certainly it's not a decrease. As we go leftward, the shift implies decrease. As we go rightward, the shift implies increase. Be very careful, students. These are all the most direct questions. Others we can't even anticipate how it will be. Do you understand? So be very clear. That's why different kinds of diagrams I'm giving. Okay. So please be careful. So a shift rightward will be increase in supply. A shift leftward will be decrease in supply. Okay. So the diagram along with the answer has also been given to you. So you will not find anything. Now this exceptions to the law of supply. It was asked. I saw it in thrice it was asked. Okay, so here how are you going to study this segment, students? Please study the exceptions to the law of supply, not just the listing of it, but why is it so, with the reason. Only then when they give you as an option, you will be able to correctly sense it. Okay, so they will give 4 factors, components, and ask you to identify. One will be an exception, and they will ask you to identify that exception. Okay, so that is why look at this. If you quickly look at all these things, closure of business. So exception to the law of supply, what are we saying? We are saying that there is these are the situations where there is no direct relationship between price and quantity supplied. So here the rise in price, rise in quantity supplied is not happening. Just as we saw exceptions to the law of demand, where we said that the demand curve will be sloping upwards, here we can say that the supply curve need not be sloping upwards, it can be downward. That is, more is sold at a lesser price also. These are the instances where more is sold even at lesser price. So price is not the incentive here. Okay, we are violating that. Producer's perspective, profit driven perspective is getting violated here. Okay, just look at this, no, closure of business. When you're closing the business, you will clear the stock at lower prices. So that's why this has been made in bold for you. So quickly looking at this, you need not have to waste time in reading everything. Quickly looking at that bold, you know the answer why it is. So exceptions are listed out. First, exceptions have been listed out, and at the second level, there is a rationale also being given to you. So study, as I was telling you, when you're doing your study as such, you just read completely. Then you can go for, when you go for your second revision or something, you can do faster ones. So look at this, closure business, because you want to clear the stock. Agricultural products, they are seasonal in nature, and they cannot, basically these cannot be stopped for long also. So monopoly, in monopoly there is no other controlling factor, because he is a price maker and he has a control over the prices. And in competition, when there's cutthroat competition, sellers want to retain themselves in the market, so they don't mind selling goods even at a low price. Perishable commodities, answer is evident. In case of perishable commodity, we know that because of the perishable nature, they have to be sold at whatever price, even though they may yield a loss. Rare goods cannot be recreated. Antiques or very rare things, so they are limited in supply. That's why even though if they command a high price, because of non-availability of it, the prices are the producer is unable to have it in the market. Then out of fashion, So look at this rare goods, then out of fashion goods. Naturally, no, it's become redundant, so they are selling it at low prices. Auction sale. So we are having a premise here that the seller is in a financial crisis and therefore he needs money at any cost. So low prices in the market doesn't affect him in any way. Then price expectation of the seller. When he expects that the price of the commodity is going to fall in the near future, so he doesn't mind selling more even though the present price is low, because in future it's going to fall further. Okay. Then stock clearance, as we already said, it could be they want to clear the old stock, therefore they're not bothering about the price, and at a low price they sell. And labor supply curve. So you don't have to have this diagrammatic explanation, because students get confused by the diagram, but just understand that in case of supply of labor, it is also an exception to the law of supply. Please note this point, this one. Please highlight it, students, jot this, because in case they ask, you may not be knowing it. They asked it once, if I remember. So kindly note this point very clearly. Okay. So one of the important exceptions is the supply curve. Backward bending. Is my voice audible, students?
Yes, ma'am.
So don't worry about the diagrammatic representation, because students have a lot of doubts on that and they get stuck with that. And you don't have that exclusively, right? So this is one exception to the law of supply. And what does it imply? We call this supply curve as backward bending supply curve. And what's the meaning of it? Initially, rise in wages. What is wage? It's a price for a factor of production, namely laborer. Now, up to a certain level, yes, as the price for the laborer goes up, that is wages goes up, supply of labor will increase. But once a certain point is reached, beyond that, wage will not be any further incentive. Any rise in wage will not be an incentive, because the worker prefers leisure. That is what is given here. Worker prefers leisure. Is that clear, students? Okay. Now let's go on to quickly into elasticity of supply. Look at elasticity of supply. What's the only change you have to know here? This yes, subscript yes. So it's like your demand elasticity formula, isn't it? Delta Q by Q divided by delta P by P, where my Q is denoting QS, which is quantity supplied. So make a note of this formula, because it's not new to you. Once you have done with elasticity of demand, this becomes easy. Okay, pretty easy. Okay, and here again recollect. Now students, I'm going to ask you one thing. What's the difference between law of supply and elasticity of supply? What does elasticity of supply tell? What does law of supply tell? This is based on the demand component, which we already did.
And law of supply tells us about the relationship between price and supply, ma'am. But elasticity shows the degree of responsiveness, ma'am.
Come again once more, please.
And law of supply, ma'am, it tells us about the relationship between supply, the positive relationship between supply and price, ma'am. That is known as law of supply, ma'am. Ma'am, but elasticity of supply shows us the degree of responsiveness, ma'am, and how much degree it responds from the changes in quantity supplied and price.
Okay, now that you have to put it like this, they will ask you like this. So when you say law of supply tells about tells a direct relationship between price and quantity supplied, it talks about direction of change, whereas elasticity answers a question by how much or rate of change. It tells us about the rate of change. Are you clear, students? So have this mind, what tells about direction of change, what tells about rate of change. That's a very important component. Okay. Now you have, again, look at this types of elasticity of supply. Relatively elastic, where ES is greater than 1, which means what? The degree of responsiveness of quantity supplied is more than proportionate to change in price. E is equal to 1. Unitary elasticity, where the degree of responsiveness of the quantity supplied is in exact proportion to the changes in price. Okay, so see, delta Q is equal to delta P. So study the formula, study the explanation and the diagram. ES is equal to less than ES less than 1. What does it mean? Relatively inelastic supply, where you find that the quantity supplied changes but less than proportion to the change in price. Look at this. Have all these notations in your mind. Done well. Okay, that's why it's been given perfectly for you, in two impressive colors. Is that clear? Then ES is equal to 0, perfectly inelastic supply, where the supply is going to be absolutely 0, and perfectly elastic supply where ES is equal to infinity. This is a case where response of supply to changes in price is infinite. So all of them you have the diagram given, starting from ES greater than 1, ES equal to 1, less than 1, equal to 0, equal to infinity. So they may give you a diagram and give 4 formulas and ask you to tick mark the right one. Is that clear? So visualization of the diagram is important. Or they may give you statements like this, or they may give you equations like this and ask you to find out. So they will say delta Q is equal to delta P, and they will give you 4 types of elasticity of supply as option. You have to tick mark the right one. So study these notations. Study these notations very carefully, and also the diagrammatic representation. Is that clear? And coming to the measurement of elasticity of supply, you have to know. I mean, they are not asked normally. They ask only elasticity of demand sums usually. But just have this. In case they are asking the sum, it's not different. 2 formulas only. The general formula is delta Q by Q divided by delta P by P. I have added this S for you to recollect and remember and register. It is about elasticity of supply. So when they ask you to compute price elasticity of demand, you can use the formula ES is equal to delta QS by QS divided by delta P by P, okay, where QS denotes quantity supplied and P denotes price, okay. And arc method, same formula. Just look at this. Same formula what we did. Only thing is here your Q is going to be a quantity supplied instead of quantity demanded, right? So look at this, original quantity minus new quantity divided by original quantity plus new quantity, the whole thing divided by original price minus new price divided by original price plus new price. In notations also it's given. Is that clear? Now coming to the final part, determinants of elasticity of supply. So this segment, students, have given you the answer itself. In case you don't have time to read lots from your book, so look at this. What does 2 things we are using? ES greater than 1, ES less than 1. So ES greater than 1 we call it as more elastic, and ES less than 1 indicates less elastic case. So nature of the commodity, 2 types of commodities are taken in this example. For durable commodity, it is more elastic. We know the reason, right? Okay, they are for long period of time. Perishable commodity, it is less elastic because being perishable in nature, it will not be, despite the rise in prices also, the supply will be very much restricted, okay. Perishable commodities do have a limitation on supply, okay. Time factor, if it's a very short time, then elasticity will be less. If it's a long period, elasticity will be more. Also we understand that long period in economics is a time where you can even increase the fixed factors. So the production can be extended to such an extent where not only the variable factors but also the fixed factors are going to be increased. So in the short time, which is not possible. Okay, then availability of infrastructure, more the infrastructure, greater the elasticity, less the infrastructure, less the elasticity, okay. Cost of production, if the cost of production is very high, then ES is less than 1. If the cost of production is reasonable, nominal or less, ES is greater than 1. And in case of availability of inputs, it is similar to your infrastructure. If the inputs are available, yes, ES is going to be greater than 1. But if there is a problem, a scarcity in inputs, then ES will be less than 1. Okay. Then risk taking ability of the entrepreneur. So if he is a risk preferer, naturally it will be more elastic. But if he is risk averse, he doesn't want to take up risk, ES will be less than 1. Is that clear? So the answer itself with example is given for you, so that you will not have any confusion. Is that clear, students? So please understand what you are going to study in this lesson, mainly what is given as learnings from the lesson. Concentrate on that part so that you will be able to do it well. Is that clear? Have you all jotted down whatever was told? Okay. Then let's go to the next point. Okay. So I will do theories of cost. Last we can do, what is that? Economies of scale. So look at this, students, theory of cost. What is that you're going to learn here? Types of cost, different types of cost. Okay, you're going to get familiar with different types of cost. Then accountants and economists perspective, very important. Then TC, AC, MC with formula, table and graph. Distinction between fixed cost and variable cost, or fixed factor and variable factors. You can put as fixed and variable factors. That's more and appealing. So look at this, students. In common parlance, the meaning of cost of production is expenses in the production of a commodity or producing a commodity. Okay, but however, from economist perspective, see, in every topic, just look at this subtle thing, common parlance, economist perspective. So that is why common parlance also will not be wrong. The option given, one of the option will be the general parlance, which is not wrong, but they will also give you an economist parlance or economist perspective, which will be very correct or the most appropriate. Okay, so please have this in mind. That's why in every topic, the Q I'm even highlighting and telling in common parlance. Now in economist thing, I see I've added also for MCQs. So what happens is, economists, they've expanded the cost concept, and they are calling it as money cost, real cost and opportunity cost. They are bringing it like that. If you ask a common man what's a real cost or what's an opportunity cost, maybe they are not familiar with this. But an economist perspective or economic theory emphasizes on all these as cost of production. Money cost, real cost and opportunity cost. See, under money cost, you have to know the two perspectives. What you have to know under each are given. Two perspectives. What are the two perspectives? Economists and accountants. Under real cost, you should know it's a subjective phenomenon. It is not enumerative. It's a psychological concept. And under opportunity cost, getting familiar with the examples, either through numerical example, empirical case example or diagram is important. Please understand, students, the three types of cost from economist perspective. Each of them have their important thing. For money cost, two perspectives, economists and accountants. For real cost, it's a subjective phenomenon. For an opportunity cost, what would you do? Please ensure that for opportunity cost, you are going to study with examples. Okay, students. Now look at this money cost. Money cost is nothing but whatever is incurred in actual business process, price which is paid for the factors of production. Look at this. I've highlighted and given. Very easy. When you see money cost, you look at this immediately. Wages for the laborers, prices for the raw materials, rent for the buildings, interest for the money borrowed. So it's highlighted. So no worry. As you just look at it, you'll be able to understand. Okay, money cost. Now here, look at this. Accountant's perspective and economist perspective. Please look at it, students. So accountant's perspective is called as explicit cost and accounting cost. And what is that? That which is accounted for, that which is directly paid out, that which finds place in the books of accounts, that which is entered, that which is incurred on the hired factors of production. And look at all these examples. Note the examples very clearly. That's why given in green. Wages, rent, interest, depreciation charges, taxes paid, sundry expenses incurred. Okay, so the examples of explicit cost are also given to you very, very clearly. Please be very clear. Okay, now coming to economist perspective, along with the accountant's perspective of explicit cost, we are including implicit cost or imputed cost. What is added? We are not saying that economist cost is implicit cost only. We are saying that it is explicit plus implicit. And what do you mean by explicit? Explicit, as we saw, that cost which is paid out, that which is entered in the books of accounts. Okay, you find entries, you make entries in the books of accounts because they are payments made to the factors of production which are hired for producing the commodity or the service. Okay, but imputed cost is that cost which an entrepreneur has to pay for himself, okay, maybe for the wages and salaries for the work performed by him, the interest on the capital contributed by him, the rent for land or buildings owned by him but used for business purpose. Look at this. So please remember, this denotes your imputed cost. Yes, students, are you able to see this? Okay.
Yes, ma'am.
Okay, so this and all will be very clear. Quickly, as you see the material, you should be okay. Explicit accounting cost. Okay, what are those? Yes. Now economist perspective along with explicit. So some people, the one mistake which students do is, okay, accountant means explicit, economist is implicit. No, that's why written here along with explicit, implicit costs are included. Is that clear, students? Please pay. And this is the expenditure which the business firm incurs, and it's not finding place in the books of accounts because it's contribution made by the entrepreneur himself. So he requires this. He has to be paid this. Okay, the expenses that an entrepreneur does not have to pay out of his own pocket, but it's a cost to the firm. So what will happen if the implicit costs are not included in the total cost? What will happen? There will be an accounting error because the cost of the firm is understated. Remember that, and look at this formula. When you revise quickly, go through this formula. Economist cost is equal to explicit plus implicit. Accounting cost is explicit cost only. Even that I have written for you. And therefore, how do we compute economic profit? TR minus total revenue minus economic cost. Accounting profit is total revenue minus explicit cost. Is that clear, students? Now let's go to real cost. Okay, so real, this is what I said, subject to concept. It cannot be quantified. It is not enumerative. Look at this: trouble, turmoil, sacrifices made. So the money paid for securing factors of production is money cost. The efforts and sacrifice of the factors or its owners is a real cost. Do you understand this, students? And basically classical economists had given the term pain and sacrifice of labor. Even Alfred Marshall has given it. He called it as social cost. Okay, you have the term cost of waiting, cost of abstinence. All these are which are associated with real cost. Okay, so it is a subjective phenomenon. It is talking about the pain, the strain, and the trouble and the turmoil. Okay, so have you understood this? Yeah. Okay, students, now let us go to the concept of opportunity cost. Who gave this? See, I'm giving you not all books give this, so noted. It's given by the Austrian economist Weiser, in case they ask you, because it was developed by the Austrian school. Okay, and what does it mean fundamentally? Now, these 4 points, okay, are important for right and wrong, correct sentence, wrong sentence. So correct and incorrect sentence, this segment is very important. Look at this. So it was introduced by the Austrian economist Weiser, and it is based on the fundamental fact that means are scarce while the wants or ends are unlimited. Okay, and what does it imply? The result is one commodity can be produced only at the cost of another commodity. This is a case where we cannot have both. We can have one at the expense of the other. Okay, so one which is foregone is a cost of one that has been chosen. Is that clear? One which is foregone is a cost of one which is chosen. Now, different kinds of examples I've given to you to understand opportunity cost. Even through a diagram I've given to you, so that different examples will make you very clear on the concept of opportunity cost. Now, let me tell you this diagram example only. So, look at this. This is basically very much related to your present time. Study hours and leisure hours. So look at the case. This student, okay, initially, look at we are taking actually study hours in the x-axis and leisure hour in the y-axis. Okay. Now look at the first thing. When I was studying for 2 hours, I had leisure for 10 hours. Now, because exams are nearing, I want to study for 4 hours. I'm extending by another 2 hours. So, when I give 2 hours more for my study time, I can do this only by compromising my leisure time.
Ma'am, I have a doubt.
Yeah.
I have an example. Is this correct? Can you say, ma'am?
Yes.
A person has 3 jobs. He can get 3 jobs. One pays him 20,000, another pays him 11,000, and another pays him 8,000. The person chooses 20,000. So here the opportunity cost is 11,000, no, ma'am. It's the next best alternative for God.
There is noise at your backdrop. Can you mute it actually? Yeah.
Now, okay, ma'am.
Somebody see, do you see that noise as soon as you start speaking? Lot of noise. Mute, others are mute, I suppose. Is this example you're trying to say? Look at this. Please look at this.
Yes, ma'am.
Labor is working in a factory, is getting 2,000 per month.
Yes, ma'am.
The entrepreneur is paying him this amount because he can earn this amount from the next best alternative. What is this noise I'm getting?
Sorry, ma'am. That's my college class. It's in the side. That's
How much noise here, please? Because I can't even hear all this. I feel that you're saying something on this. Is that so?
yes, ma'am.
2 opportunities of job. Look at this. Yes, correct. Then your example is correct. See, I've given you multiple examples of opportunity cost so that you understand the concept clearly. One can be obtained at the expense of the other. It's a cost of the next best alternative, that next best only, not the first best, next best only, that is foregone. Look at this. Let me complete this example. So initially the student was enjoying 10 hours of leisure when he was studying for 2 hours. During the exam time, or nearing towards exam time, he is extending by study hours by 2 more hours, and totally he is devoting 4 hours. And this additional 2 hours can be obtained by him only by compromising his leisure time. So from 10 hours of leisure, now he is having only 8 hours. So this extension of 2 hours was possible by the decline of this. You can have lot of examples. I've given a lot of examples, so that you will know what's happening and all. Okay, so please understand, students. So in opportunity cost, you have to understand the intricacies. So this example, again, look at this intricate example. An entrepreneur contributes his own money worth 20,000, or not, sorry, 20,000. Okay, 20,000 rupees towards his business. Now this money alternatively could have been used for lending at a rate of say 10%. Suppose now, having invested in business, he is getting a profit, say, it's an imaginary example, that's why the amount is very less, say 1,600 rupees. Alternative proposal of loans would have yielded him 2,000 rupees per annum. So according to this principle, the entrepreneur has lost 400 rupees because had he lent the money, he would have gained 2,000, whereas now he is earning only 1,600. Can you understand this? So you have to analyze opportunity cost and understand opportunity cost through various examples. Look at this also. Labor is working in a factory and getting 2,000 per month. The entrepreneur is paying him this amount because he can earn this amount in the next best alternative. So if he pays anything less than this amount, then he will go to that occupation where he can get 2,000. Can you understand, students? So this is a very important understanding of opportunity cost. Even with an example like this, you can learn. Okay. Now coming to the other types of cost, quickly look at the other types of cost. Outlay cost. It talks about the financial expenditure, expenditure recorded in the books of accounts. Actual expenditure recorded in the books of accounts. Example have been given. Direct and indirect costs, costs which are traceable. I can identify it. For what purpose? They are direct costs or traceable costs, and those that cannot be identified. For example, it's on general business operation. Then you can't identify. Common costs. What you call as common costs. So that is coming under indirect costs. Then difference between marginal and incremental cost, very important. See, marginal cost we may know. Addition made to the total cost by the production of one more unit. Whereas what is incremental cost? Incremental cost is also an increase in the overall cost or a change in the overall cost, but that is happening because of a particular decision taking. For example, you are going for a new marketing strategy or a new promotional strategy, okay? That because of that decision, there is a hike in the cost. So incremental costs are defined as a change in the overall cost that result from the particular decision being taken. Okay, please understand that there is a subtle difference between marginal cost and incremental cost, but some outside economics, you find it's used interchangeably, but there is a subtle difference. That is what I have given to you in this chart. Okay, sunk costs, those that cannot be recovered, there's no guarantee. It's once and for all. For example, we invest in R&D, we invest in advertising. There is no guarantee that you're going to get the result or the output, but it has to be incurred. It's crucial and it's done once for all. Okay, sunk cost. Historical cost, I think this is very, very common even in accountancy for you, isn't it? The historical cost and replacement cost. So historical refers to the cost incurred in the past on the acquisition of the asset. Okay, and replacement is the expenditure that has to be incurred on replacing that asset. Do you understand? So for example, 10 years back, X got furnitures for 10,000 rupees, and after 5 years,
R&D is research and development, ma'am.
Exactly, yes. R&D is research and development, correct. Now after 5 years, now when X is replacing the old furniture, the cost is he is incurring is 20,000. So this is your historical cost, this is your replacement cost. Okay, and private cost. See, private cost is nothing but cost actually incurred to produce a commodity. Okay, that is already there. But what is new is the social cost. You can say in simple terms, you can say that social cost is equal to private cost plus externalities. That is the cost borne by the society. For example, when your when a business enterprise operates, if it is making use of the water available nearby, or it's disposing of its residue or waste in the water nearby, the pollution it causes, all these are the impacts on the society. It can be both positive or negative, but impacts on the society, when that is also taken into account, you call it as social cost. So private cost is actually the cost incurred on production of the commodity, whereas private cost plus what is the impacts on the business society, impact of the business activity on the society, becomes social cost. Okay, now these are all the types of costs. Please understand, this part is very easy. If you know whatever is given here, you're done with this chapter. Now go into very intricate segment. Fixed cost and variable cost are very important. Please note it there. Fixed cost and variable cost. That's why I've given you what are the fixed factors. I've given you what are the fixed costs. I've listed out. So if you read this, so they will ask you, one among this is not a fixed factor. One among this is not a variable factor. For that purpose only, it has been factors of production have been divided into fixed factors and variable factors. So look at the fixed factors: equipment, machinery, plant, land, buildings, permanent staff, and cost incurred on these are called as fixed cost. So what are the fixed costs then? Costs that are incurred on fixed factors: rent for the buildings, interest on capital, salaries to the permanent staff, wages to the watchman who is permanent. Look at this. Insurance premium, property taxes, maintenance cost. So economists here again divide the factors. From economist perspective, again factors of production are divided very clearly into fixed factors and variable factors. I have listed out the fixed factors, listed out the variable fixed cost as such. Likewise, you have variable factors and variable cost. Please note down this as very important. Student, this part is very important. Now what is fundamentally the difference between the two you are going to see. So look at the variable cost. Variable factors are those factors which get exhausted with a single use, and procuring these factors is very, very difficult. procuring these factors is easy. So they get exhausted with a single use, and they will vary with the level of output, with the changes in the level of output. Okay. So look at the variable costs: payment for the laborer, casual laborer, payment for raw materials, payments for fuel, power, etc. All this. Now, what is this? This part is there, asked many times. Note this as very important. Please note it. So please note it as very important. Okay, so the distinction between fixed and variable factors. See, remember, variable factors are those which vary with the changes in level of output, and they can be changed in the short run also. When you look, when I want more casual labor, when I want raw materials, fuel and power, it's easy to procure. Whereas when you look at the fixed factors, procuring them requires a longer time. In the short run, you cannot procure all these things. It's very difficult. Not only the investments are lump sum and heavy, but also it's very difficult to procure them actually. So in the short run, so you find that in the short run, only the variable factors can be changed. Fixed factors cannot be changed. In the long run, all the factors are variable, because the long run is a period long enough to vary your variable factors. You can procure land, you can procure machinery, buildings, whatever it is. Okay, so look at this segment. Fixed costs have to be incurred even if the plant is at a standstill. These costs have to be done whether there is an output or not. It will be happening. Okay, variable cost vary with the output changes. If there is no output happening, there will be no variable cost. And distinction between fixed cost and variable cost is there in the short run. It will not be there in the long run. Most important points. Right? All the three are very important from the examination point of view. So fixed costs have to be incurred even if the plant is at a standstill. They remain fixed. They do not vary, which means they do not vary with the variation in the level of output. Whereas the variable cost, they vary with the variations in the level of output. See, only if I am going to produce, I will require raw materials. If I am not producing, I will not require raw materials. So there will be no cost incurred on raw materials. Whereas the plant and machinery, they are there. So whether they are hired or owned, you have to spend on that. Okay, that's the meaning. So all three are very important. Now let us go to, so you have understood what's a short run and long run. Short run is a period where variable factors will be varied, whereas fixed factors, which are said to be scarce in supply, apart from having lump sum investments, cannot be changed. And in the long run, all the factors, both fixed and variable, are variable. It can be changed. Now look at this TFC. As the name itself implies, is a cost of the firm's fixed resources. Fixed cost is to be incurred even if the output of the firm is zero. I am highlighting it everywhere. TVC. What happens? The TVC is linked with the level of output. When the output is zero, variable cost will be zero. When the output increases, variable cost will also increase. Okay. And what is total cost? Is a summation of fixed cost and the variable cost incurred. So look at the formula. TC is equal to TFC plus TVC. So if supposing your TVC is 50 rupees and if your TC is 250, you will know what is your TFC, which is 200. Look at this formula. TC is equal to TFC plus TVC, where TC is total cost, TFC is total fixed cost, TVC is total variable cost. Note this diagram. The question will be asked like, why TFC starts from here, why TVC starts from here. TFC starts from here, indicating that even at the zero level of output, the fixed cost continues. It does not become zero. Fixed costs have to be incurred. That is what I gave you as important point. Whereas in case of variable cost, when the output is zero at this level, the variable cost will also be zero. As the output increases, variable cost will increase. This point is shown there. These 2 points, see, The fixed costs have to be incurred even if the plant standstill is shown by the straight line, horizontal line parallel to the x-axis starting from a point above. Okay, and variable cost, you are starting it from the origin, indicating that if the output is nil, variable cost is also 0. So look at this point. At this point, output is 0, variable cost is also 0. But you look at TFC, output is 0 because x-axis is output, no? Output is 0, but cost this much is incurred, which means even if the output is 0, fixed cost will be incurred. And what is TC? It is a summation of TFC and TVC. So it will take the shape of, it starts from here and it will follow both TFC and TVC. Okay, so look at this explanation, students, from the examination point of view I have given. And other types, semi-variable cost. For this only I have given you. One portion is fixed, one portion is variable. Very good example is our landline telephone, even electricity. All these you will have one component is fixed. The other component is usage based. That will come under semi-variable. Stay step. So stay step indicates the cost which will be stable for some time, sudden sporadic rise. Stable sporadic rise. Stable sporadic rise. This is because of the output changes. Output grows as output extends. So that's why this is explained with the example of this. A sudden hike in the salary of the foreman at the factory level owing to the expansion in the production. Okay, as the output crosses a particular limit, you have to give him more salary. Okay, so salary of the foreman as such goes up. Then it will be stable for some time. Again, the production level goes up, a new recruitment is made, along with that there is a hike in the salary of the foreman. So it is shown like this. And another interesting coffee shop example I have given, I have added. If you are interested, go through that. Okay, then go to average cost. What is average cost? Please remember, unit cost or per unit cost. It is cost per unit of output. Please remember that. TC by Q. TC by Q is AC. Delta TC by delta Q is MC. Please remember this. TC by Q is AC. Delta TC by delta Q is MC. So if they give you say any one of this, any two of this, and ask you to find out as a question mark, as I showed you one example there, yes, you must be able to fill it up. You will be able to do if you are having that formula with you. Okay, so what is TC? TC is nothing but average cost into quantity, output. And MCN, marginal cost, another formula is TCN minus 1. It's an addition made to the total cost by producing one more unit of a commodity. Okay, so AC is TC by Q and MC is delta TC by delta Q, because this is per unit cost. Average cost is per unit cost. Marginal cost is addition made to the total cost by one more unit of a commodity. Okay, now look at this, students. All this formula, you can just go through. Individually what we did is this tabulation, the slide will help you to have an idea. Okay, numerical example. Look at this as you do for TU and MU, no? Same thing. So they will give you a question mark where you have to add. For TC and MC, it's similar to your TU and MU. So how will we calculate TC when MC is given? We will add up. We will add up and we will give. Okay, addition made to the total cost. And how will you find out the marginal cost from total cost? The difference between successive total cost. The difference between successive total cost will give you the marginal cost. Okay, so go through this table also. You yourself, block and put a question mark and go through it. Now coming to the shape of the average cost curves. Average fixed cost, average variable cost, and based on that average total cost. Remember, average fixed cost going down, average variable cost coming down, going to the minimum point, going up. Then you have the average total cost or average cost. It is also U-shaped. And remember your marginal cost, which is also U-shaped and which will pass through the minimum point of the AC curve. Okay, look at all these points given to you. Remember, AC curve is U-shaped curve. Okay, the shape of the AC curve is U-shaped. It depends upon the behavior of AFC and ABC. So remember, all these 4 points on the graph are very important. So in the beginning, both AVC and AFC will be falling. So ATC falls. After some time, your AVC will rise. At that time, AFC will be falling. Therefore, ATC will also fall. But after a point, when AVC is rising, which offsets a fall in AFC, ATC also rises. So the shape of the AC curve in simple terms is determined by the shape of the AFC and AFC. The influence of the AFC and AVC determines the U-shaped ATC. Is that clear, students? Have this point very clear. Now the other things, AFC is called as a rectangular hyperbola. You know, no, you have studied rectangular hyperbola in the mathematics, no? We say it's a curve under which all rectangular areas are equal. So we call AVC similar to a rectangular hyperbola. So I've given you that, and we also notify it because AFC is equal to TFC by Q. Is that clear? Because the total fixed cost remains fixed at all level of output. The total fixed cost will remain. So with the rise in the level of output, AFC will fall. That's what we are trying to say here. Okay. So the total fixed cost is going to be the same. Okay. At all levels of output. So with the rise in the output, units of output, AFC will start declining. That's how you have to understand AFC. Is that clear, students? It's a rectangular hyperbola. Now marginal cost curve, U-shaped curve. Remember, marginal cost curve is independent of the fixed cost. Okay, and marginal cost curve is determined by law of variable proportion, which means, see, when the curve is coming down, it denotes a declining cost or increasing output, and this portion denotes rising cost or declining output. Okay, U-shaped curve. MC curve is U-shaped curve, and the MC curve, look at it, it's passing through the minimum point. Separately, I also have shown this. And what will happen? The relationship between MC and AC. So what will happen? Look at the 4 points relating to MC and AC. MC cuts the AC curve at the minimum point of the AC curve. Look at this. MC cuts the AC curve at the minimum point of the AC curve. Okay. And when MC is increasing, what will happen? When in fact, it's rising above AC, AC will also rise. When MC is below AC, AC falls. And when MC is equal to AC, AC remains constant, because MC is an addition made to the total cost by that one extra unit. So the influence of that one extra unit on cost per unit is shown. The influence of one extra unit, that additional unit, the cost of that additional unit, the influence of the cost of the additional unit is shown on the unit cost. That is summed up in this portion. Is that clear? And finally, we have a table. Please do this exercise and see. So they will give you TFC and TC. They'll ask you to find out TVC. Or they will give you ATC and AFC. They'll ask you to find out AVC. Now that formula for everything is being given to you. It's very clear. Look at this. Here also I'm giving you the formulas. AFC is TFC by Q, AVC is TVC by Q, and MC is equal to delta TC by delta Q, TC is TFC plus TVC. So applying all these formula, try to work out this numerical example. Is that clear, students? Are you clear? Even what is given in this itself is an example only. You don't have to hunt for numerical example. What is given in your material itself, you can just go through. Is that clear? And one more small component we have in our cost topic. Cost topic is not over. We have to do what is called as a plant curve and planning curve. Okay, that segment also we'll do. Plant curve and planning curve. Yeah, students, you need some 5 minutes break or something like that. Am I dumping too much?
No, ma'am. Yes, yes, ma'am.
Yes, ma'am.
S is for what? Your S is for what?
Break.
Break. Okay. So it is 10:50 here. So can we be back at 11?
Yes, ma'am.
Very good. That's very sweet of you to reply. Thank you. Have a break for 10 minutes. that we don't get disturbed. Okay, now look at this segment, theory of cost, as we have done part 1. Look at this part 2. This is very important. Look at this plant curve versus planning curve. Please understand, this is very important segment, and it's been prepared in a very crisp form for you, so that you will not have any issues. So what's important here is what denotes a plant curve. Short run average cost curve is otherwise known as plant curve. Long run average cost curve is otherwise known as planning curve. Now why is it called as a plant curve? Because short run is a period where factors like plant are fixed in nature and they cannot be increased. So output can be expanded only with the variable factors, and the fixed factors cannot be changed during this period. Okay, now just look at this simple example. So this diagram itself tells you that. Okay, so you have this plant 1, curve 1 denotes a plant 1, then you have plant 2, you have plant 3. Okay, and the cost incurred on each plant is given here: SAC 1, SAC 2, SAC 3. Okay, so they denote SAC denote short run average cost curve, and the numbers 1, 2, 3 denote plant and machinery. Okay, so supposing the firm which is producing OB level of output, okay, OB level of output, incurring an average cost of QB, okay, it wants to expand the output from OB to OC level. Remember, short period, it cannot go for another plant. So on the same plant, that is SAC1, that is plant 1, if it is using that plant to produce OC level of output, look at the cost incurred, JC. Now, if it is long period, they can install another plant, because long period is one which is long enough to ensure the availability of fixed factors like plant. So in the long run, to expand the output to OC level, a new plant may be inducted, SAC2, and look at the cost of producing that, KC. So you find KC lower than JC. So what are we trying to say here? What are we trying to say here? We are only trying to say here that in the short run, the idea of expanding the output may not be feasible always, because the firm is stuck to a plant. It doesn't have the option of going for other plant, one more plant, which may bring about an optimum output. So OC at KC is a better optimum output than OC through SAC1 incurring JC. Are you understanding, students? Look at this. So I am producing OB level of output with plant 1. If I want to produce OC level of output, being a short period, only one plant, I cannot have more plants. That's why we saw in the beginning itself, fixed factors can be varied only in the long run. Because of the scarcity of this, certain factors are kept constant, and those factors are termed as fixed factors. So in the long run, what will happen? You can induct another plant, and the extension of output or producing OC will be done at a very optimum cost of KC. Okay, so that is what is explained here. Okay, so in the short run is a period where fixed factors cannot be changed and variable factors alone can be varied. So look at this. So the explanation for the diagram with tips from the examination point of view have been added. But in simple terms, I gave you the diagram. Look at the long run average cost. This is the planning curve. Look at the shape of the long run average cost is U-shaped or flattened U. It's called as U-shaped or flattened U. Look at this. It is also known as envelope curve. It's known as envelope curve because it envelops a family of short run cost curves. See, look at this. This base curve is the long run average cost curve. Are you understanding, students? This base curve is the long run average cost curve. Am I clear? Are you able to understand this? Look at this. This is your LAC. It is enveloping a family of short run average cost curves. Therefore, it is called as envelope curve. Okay, so look at this. I have also given you this part, and it is known as planning curve because it helps in choosing the firm, in choosing an appropriate plant with which it can produce a desired level of output. Desired plant. Okay, so what is known as a planning curve? LAC. What is known as an envelope curve? LAC. What is known as a plant curve? SAC. Those are the questions here. Note down plant curve, planning curve, envelope curve. Okay, and I've added a little more examples. And now remember the shape of the LAC. Make a note of it. Flattened U shape. That's a common thing. But in the modern days, where the firms are taking into account changes in the state of technology. Remember, this flattened U shape, all this are based on the assumption that the state of technology is constant. Supposing we are going to take into account the advancement in the state of technology, then the shape of the LAC will be L. So, empirically speaking, modern firms face a L-shaped curve when they take into account the advancements in the state of technology. Conventionally, it is flattened U shape. Okay, what is the shape of AC? U-shaped. MC? U-shaped. LAC? Flattened U-shape. If you take into account technological changes, L-shaped. Right? Now I've just given you how at constant returns to scale, look at the shape of the LAC. It will be a straight line parallel to the x-axis. This is a long run average cost curve at constant returns to scale. Look at it. It is also envelope. Look at this. It's enveloping all the short run family of short run average cost curves. SAC 1, 2, 3, etc. By connecting all these points, I get LAC, and all of them are at the minimum point. But when you take the variable proportion, this is LAC at variable proportion. This part till here, it is the case of declining cost, increasing output. This portion after this reaching the minimum point, PQ, look at this point. This is a SAC4 is a minimum cost curve. Okay, where OQ is produced at the minimum cost, PQ. Okay, so this before P or till P, it is declining cost or increasing returns, and beyond P it is increasing cost or declining returns. Okay, this is based on variable proportion, and this is based on constant returns to scale. Okay, so maximum possible questions I have given you. Okay, so the core points of this diagram also I have listed below. It's a very short topic and purely done from the examination point of view. Okay, so shall we move on to revenue? Yes, let us move on to revenue segment. Again a small topic, as I was telling you. It's easy for you to understand revenue segment because once you know TC, AC and MC, TR, AR and MR becomes easy. So study TC, MC and AC, the table very well, so that TR, AR,
Ma'am, in today's class, we will do market structures also, ma'am.
Yeah. After this, we are entering market structures. It's only 11:15, no? So till 1:15, 1:20, I'll go on. Market structures, yes. Today I'm doing. Okay, so now let's go on to the next important segment. Okay, theory of revenue. Look at this, students. Crisp from this topic is basically done having in mind exam only. Nothing is at all. Things have been deleted. What is the core only is given here. What is this? Look at this part. Now look at this. The amount of money which a firm receives from the sales of its output in the market is termed as revenue. Again, look at this in economics. Concept of revenue is given importance. TR, AR. What is TR? Quantity into price. Look at the income earned by a seller or producer after selling the output is called as total revenue. What is average revenue? Average revenue refers to the revenue obtained by the seller by selling 1 unit of a commodity per unit revenue. Like per unit cost, it's per unit revenue. So formula is AR is equal to TR by Q. So now you will know what is MR. Delta TR by delta Q. You yourself must be able to know. Okay. Now, yes, MR is equal to delta TR by delta Q. Okay. Revenue which is obtained from one more unit or one extra unit. Okay, now this AR curve, we are calling this cost topic and revenue topic as a prelude to market structures. Why? because we will know how the shape of these curves will be. We are learning here itself. Look at this. AR will be equal to price in case of perfectly competitive market. AR will not be equal to MR in case of imperfect market. Is that clear? Now look at this also shown in the table. So under perfect competition, look at your AR column and look at AR, which is price column, and look at your MR. They are the same. And this is because of the feature of homogeneous product and uniform price. This essentially lies on the feature of that market structure. Namely, a perfectly competitive market will have a homogeneous product and uniform price. That justifies AR and MR being equal. So, look at the units of output and average revenue. That is, revenue from one unit of a commodity. What is TR? AR into Q. Look at the calculation. And MR. Addition made to the TR, throughout it is 10. So AR and MR are same. Okay. And market price is constant. Now, this is how your curve will be. When you present, look at, take the output on the x-axis and price on the y-axis. Here in your demand curve, MR curve, AR curve, price are all same because they are embedded upon the feature of perfect competition, that in a perfectly competitive market, homogeneous product and uniform price prevail. Do you understand that? So that is perfectly competitive market. And look at the imperfect market. Now students, since the numerical table is given, this itself you can read. If you are not able to, not having time to look into your parent institute material table or any other reference, please look at this table itself to understand how they are computed. You yourself can do this because it's worked out. Answer is given then and there. So what is AR? What is TR? What is MR? How it is computed? TRN minus TRN minus 1, or it can be delta TR by delta Q. So what is TR? AR into Q, price into Q. Look at this. Output is given here, price or AR is given here, TR is given MR. Now this is a case of imperfect market. They don't have homogeneous product, no? So you are not finding your AR and MR to be equal. So AR is declining, MR is also declining, and MR is declining steeper than the AR. So how will the curves be in a perfectly imperfect market? They will be like this. AR is declining, MR will also be declining, but MR will be below AR. AR is declining, MR will also be declining, MR is below AR. Can you understand, students, in an imperfect market what is happening? So, in an imperfect market, a firm can sell larger quantities only at a low price. Okay, so AR or price will be declining. Is that clear? So, it will decline just as your MR demand curve, it will be declining. And since AR is declining, MR will also be declining. That addition made, the additional units also fetching lesser and lesser revenue. So, the shape of AR and MR in an imperfect market and the shape of the AR and MR in a perfect market is given in this topic itself. Apart from telling you the formula of AR, MR and TR and also giving a table, we are also seeing how it will be, how the schedule and the curve of AR and MR will be in a perfect market and in an imperfect market with the reasons are given. Are you clear, students? And one more point we wanted to say is that in case of this market, it need not be a straight line. It can be a straight line, it can be a concave curve, it can be a convex curve, whatever be it. As far as the point, they are declining and MR will be less than AR. That is, these are all the maximum points you have to learn in theory of revenue. This much if you learn, your preparation on this topic is adequate. Is that clear? Okay, let us go to our fundamental topic, market structures. Fundamental topic, market structures. So be thorough in market structures so that you will feel confident. Basically, you will feel confident because there you have perfect competition, monopoly, monopolistic competition, oligopoly, isn't it? Okay. So, look at this, learnings from the lesson. Now here students, meaning of the term market, types of market based on criteria with examples, short run and long run period with the influence of market forces. Competition based market forms with meaning of the term and examples are given. Okay. Now first point, please jot this down. Market does not refer to a place in economics. That's the first thing you have to know. Market does not refer to a particular place. Okay, it is not referring, it is an institutional arrangement. It is an arrangement or which indicates a negotiation, price negotiation between the buyer and the seller. So we call it as an institution, an economic arrangement. Please understand that point very clearly. Okay, so market is not a reference to a particular place or location. Okay, so in common parlance you have that. Look, that's what I told. In every segment I've given you what is in common parlance, what is in economics. In common parlance we call market as a place, but here in economics we call it as an institutional arrangement, an economic arrangement where the buyers and sellers meet. So what does market require in economics? Existence of a commodity, two parties, namely buyers and sellers, and the competition among the buyers and sellers. According to demand and supply forces, price will get settled. So here among the two types we saw value in use and value in exchange. Value in exchange is getting importance as far as market mechanism is concerned. And remember, name of the economist Ricardo. So value in exchange or exchange value according to Ricardo means command over the commodities in general. So make a note of this name of this economist Ricardo. Okay, and already we have seen adequately about value in use and value in exchange even in our first discussion itself. I think it's in nature and scope of economics, but here with reference to market we are bringing in this terminology. So basically market indicates a potential to trade. That's all. A market is a collection of buyers and sellers with potential to trade. Their interactions, their negotiation defines market. So it's an economic arrangement, it's an economic institution. Do you understand, students? So that is why we say market need not be formal or held in a place. You have e-marketing, online marketing, right? So in fact second-hand goods market and all, it will be done through advertisements and an online platform. So the high-tech world has changed everything. With a click of the mouse everything is available, right? Okay, now this segment, elements of market, please note it. So when you say in economics, market is not a it's not a reference to a place or a location. What does it mean? So these are the elements. There should be buyers and sellers, products or services, price negotiation or bargaining, knowledge about the market conditions, and one price, ultimately which will be there, right? Now classification of market on different criteria and based on competition is very important for further understanding. This is more. Okay, so based on all other forms we have to go through based on the criteria and an example. Please have the example also in mind, because suddenly if they give you an example and ask what type of market, you should not blink. Okay, so that's why it's important. So on the basis of look at just let us have a quick look at types of markets. So note this as an important question, and so that you will be able to, when you do the revision it will facilitate you. So on the basis of geographical area, local market, that which caters to the people of the vicinity in the local area or a region, right? And look at this, perishable goods are those locally supplied services like hairdressers or retailers which have a narrow customer base. Local market. So on the base of geographical area you have local markets, regional, national and international. So what's a regional market? It's a wider, little more wider than a local area. Maybe it is incorporating few adjacent cities, parts of the state, cluster of states, etc. Okay, so it's localized to state only and not outside the state. Okay, so whatever statement is given here is important. Okay, and we have a regional market that could cover maybe a district or something like that, and it may deal in basically in durable goods. It could be industrial products or agricultural produce, but they are consumer and durable and non-durable, from agriculture to industrial commodities are dealt with here. Okay, not to worry. Then national markets, that which are limited to national boundaries, right? That which are limited to the national boundaries. Of course, they are bounded by the policy of the government and the catering to the needs of the nation. Okay, example of regional books, national books is given. For example, Hindi books may have a national market in India, but outside India you cannot find it. Okay, for example, food grains, for us rice or wheat is a staple which you may not find in Anglo-Saxon economies. Okay, so you have the national boundaries defining this type of market, and international markets which transcends national boundaries. Your gold and silver market is a very good example of it. Basically, when you look at that which transcends the national boundaries on the basis of time. So here Alfred Marshall has given this. Note it down. Alfred Marshall has given a time element in value analysis. Okay, and the 4 different types of periods: very short period, long period, and very long period. Here what you should know, in very short period, which is having a demand, which is having a influence of the 2 market forces, demand and supply, which will have an influence on setting the price. That is what you have to know. Okay, so here a very short period, supply is fixed, so an increase in demand will raise the prices. Okay, look at the example, perishable commodities. Then you have short period. So what happens, short period is the one where the fixed factors will be given, as we have already seen. So any change can be brought about only by changes in the variable factor. So there will be moderate adjustment in the supply in the short period. It's not completely sticky. A moderate adjustment will be made. Okay, in the short period. So supply of output may be increased by increasing only the variable factors. Okay, and because supply can be adjusted to some extent, the influence of demand will be less than the market period or short period. Then long period, all the factors become variable, and therefore the interaction between long run supply and demand determines long period price, or what you call it as normal price, long period equilibrium price or normal price, right? And you have very long period or secular period. Hardly this is taken into consideration, because it talks about 10 years, 15 years, 20 years and such things. So in economic analysis, basically we take into account short period and long period. That's a very common in usage. Okay, then based on transactions. So in this segment, in Marshall and analysis, please look at what is having control over the price, whether it is demand or supply or both. That is one thing you are going to do. Okay, then based on transactions, spot transaction, forward transaction. So what's a spot transaction? So there where the money is payable either immediately or within a short period of time. Okay, and when you talk about forward or future markets, it's a promise to pay and deliver goods at a future agreed date. So spot market versus forward market based on transaction. On the basis of regulation. So what is a regulated market? Very good example is a stock market, where certain regulations are put in so that the speculation does not cause an havoc on the economy as a whole. Okay, and unregulated markets are those where you have no such stipulations, like shandies or whatever it is. No, you don't have that regulation. And based on volume of business, wholesale market and retail market, we know the terms of wholesale and retail are very common to you. And based on competition, this part is very important. Okay, perfect competition, imperfect competition, and perfect competition defined by its features, and imperfect competition has all these forms. Look at the different forms of for example, monopolistic competition is a blend of monopoly and perfect competition. Then what is monopoly? It is a situation of single seller. Okay, then mono means single, poly means seller. Okay, oligopoly, few sellers. Oligo means few and poly means sellers. Okay, and some examples have been given for you. And duopoly is a 2 seller market, 2 dominant sellers. It's a subset of oligopoly. What is monopsony? Single buyer. Okay, example of a government procurement is given to you. Monopsony is a single buyer market. Okay, and what is bilateral monopoly? So bilateral monopoly is a situation of single seller meeting single buyer, single seller meeting single buyer. Okay, so that is coming under bilateral monopoly, a monopolist facing a monopsonist. Can you understand, students? With the examples have given to you, so go through that. And what is monopsony? It is a factor market situation. Here also there are a small number of buyers, big buyers, because who are the people who are going to procure factors? They are the business people, traders. Okay, so based on competition under imperfect market, you have monopoly, monopolistic competition, oligopoly, oligopsony, monopsony, bilateral monopoly. Okay, monopoly is single seller, monopsony is single buyer, bilateral monopoly is single buyer meeting single seller. Okay, oligopsony is with reference to the factor market. Understood, students? Are we clear? Yes, are you clear with this segment? So, several common examples have been given to you so that you become familiar with this concept. Is that clear? So, please be very clear with the term market and different types of market based on competition. That is the highlight of this topic. Okay, and Marshall's time element in value analysis, this part, understand, read that segment, whether it is demand which is having influence or supply which is having influence on price or both. That's what you have to know. Are you clear? Yes? Yes or no? Are you able to follow?
Ma'am.
Yes, ma'am.
Yes. So let us go to the perfect competition. I think that's where we have to. So look at perfectly competitive market. Features with examples, short run and long run equilibrium, equilibrium conditions, profit making condition, shutdown point. That is how you have to study. Okay, other things. So remember, in look at the features now. Large number of buyers and sellers, homogeneous product implying uniform price, free entry and exit. When these three are there, it's called as pure competition. Okay, and when few more features are added, it becomes perfect competition. What are those features? Perfect knowledge on the part of buyers and sellers, and absence of transport cost, absence of government intervention, then perfect knowledge on the part of buyers and sellers is perfect mobility of the factors of production. So when three features alone are met, it is called as pure competition. It is not any three features, but three defined features. Look at this. Three defined features. So when these three are there, large number of buyers and sellers, homogeneous product implying uniform price, free entry and exit, they are called as pure competition. For perfect competition, few more features are added: perfect knowledge on the part of buyers and sellers, perfect mobility of the factors of production, absence of government intervention, low or no transport cost basically. And when you have that, and then firms are only price takers, industry is a price maker, all this will make up perfect competition. Three features alone define pure competition. When additional features are added, you get perfectly competitive market. Now remember this point also. Generally, a perfectly competitive market is seen as a myth. You cannot, because absence of government intervention, no transport cost, all these are very difficult to find, isn't it? They're all difficult scenarios or conditions. They cannot be met. So what do we say here? We can have some remote examples to explain the feature of, say, homogeneous product, uniform price, something like that, no? So what is given as examples by the economists for this is agricultural products, financial instruments like stock, bonds, foreign exchange, precious metals. They are some sort of perfect competition. Okay, otherwise it's seen as a myth. Now equilibrium condition, jot down this as important. MR is equal to MC, MC curve should cut the MR curve from below. Two important conditions for equilibrium. MR should be equal to MC, MC curve should cut the MR curve from below. Now these two conditions alone are met, you cannot find out whether it's the firm is making profit or loss. Therefore you need to introduce two tools. What are they? AR and MR. Average revenue, average cost. When AR is equal to AC, it is normal profits. When AR is more than AC, it is supernormal profits. When AR is less than AC, it's loss. Okay, understand students? Okay, and when AR is equal to AC, we call it as normal profits, and economists call it as zero economic profit. Economists see it as zero economic. We saw no the difference between explicit and implicit cost, or accountant's perspective and economic perspective, where an economist will also include imputed cost while analyzing, isn't it? So when AR is equal to AC, it is normal profit, accountant's perspective, or zero economic profit. Okay, then when it is AR is greater than AC, it becomes supernormal profit. AR is less than AC, it is loss. Now look at this. In a perfectly competitive market, firm is only a price taker, industry is a price maker. The industry is given here: demand, supply, intersect, equilibrium point. OP is the equilibrium price, OQ is the equilibrium output. Okay, now this firm has given the OP price, it is extended, then you get the perfectly competitive firm here. So we already saw in that prelude topic of revenue, demand will be equal to AR, which will be equal to MR, straight line parallel to the x-axis, based on homogeneous product uniform price theory. Okay, then you have the coming to the three situations. Short run, what are the cases? Long run, what are the cases? In short run, the firm will face, they will have supernormal profit or normal profit or loss. Okay, now let us see. And one more point here we are adding, no, industry is a price maker, firm is a price taker. That's okay. Now there are 2 points. Which point will be taken as the point of equilibrium? T is an equilibrium point, R is an equilibrium point, because in both these points MR cuts AR. Okay, the point is MR should be equal to MC should be equal to MR. MC curve should cut the MR curve from below. At point T, only one condition is met. What is that condition? MC should be equal to MR. Yes, at point T, MC is equal to MR. But what is the condition which is unmet? MC curve must cut the MR curve from below. Here it is cutting from above, and after this point it's going down. But look at point R, MC curve is cutting from below, so that after the output, after this point, it will increase. So there will not be any inclination for the seller to sell more output. Okay, in this case you see, in case of T, you just see, no, your MC curve, if it is from above, it's cutting and it's going low, then why will he stop at Q1? It will get extended further, na? So an equilibrium point is one where the inclination to change will be less. It's a more or less a stable situation, no? It's a stable situation where the inclination will be less to change from that particular situation. So in point R only the two conditions are met. What are those two conditions? MC curve should be equal to the MR curve. Yes, it is at point R. MC curve should cut the MR curve from below, and after the point of equilibrium or equilibrium output, it should go up. That is met at point R. So when they give you a diagram like this and ask you at which level, so they may give you like points like this and all, and which is the equilibrium point, indicate a point where the two conditions are met. MC is equal to MR, and MC curve cuts MR curve from below. Is that clear, students? That's what is very important. Look at the case of supernormal profit. So draw your AR, MR, look at it. AR is equal to MR, which is equal to price. Okay, and let us draw our MC. Let us draw our MC. MC is equal to MR. Equilibrium point is R, and look at it, MC curve is cutting the MR curve from below. So R is the equilibrium point. So what is happening? How to find out now whether it's making profit or loss? What should we look at? We have already the AR curve. We have to insert the AC curve. So we are inserting, so you find your AC curve here. Look at my AC curve. U-shaped AC, or remember already we have done U-shaped AC? Yes. So at the equilibrium level of output, once the equilibrium point is determined, that is equilibrium price and equilibrium output. Now look at my AR is at point R and AC is at point S. So RS is what? AR greater than AC. When AR is greater than AC, it is a case of supernormal profit. Yes or no? Look at this, firm earning supernormal profit. AR is greater than AC. So RS is a profit per unit of output. So total supernormal profits is given in the shaded area PRST. Is that clear, students? That's what is given here. Okay, look, a brief explanation I've given so that you will not find it tough. Normal profit means what? Look at it, AR is equal to MR is there, and you have to find your first, after drawing AR is equal to MR, immediately you should draw only the MC, because first determine the equilibrium point. MR is equal to MC, MC curve cuts MR curve from below. So drop down the curve and you have OQ as equilibrium output, and drop down the curve to reach a point price and find out the equilibrium price OP. So OP is equilibrium price and OQ is equilibrium output. Is that clear now? So what is the tool we need? We need AC curve, ATC or AC, whatever it is. In that tool will tell whether the firm is making profit or loss. Now look at this. Look at your AC here. It's a case of normal profit, right? So your AC will be equal to AR. In case of normal, AR is equal to ATC. Look at this point. So in this point, so the firm can also make normal profit. It can also incur loss. In the short run itself, three possibilities are there: supernormal profit, normal profit, losses. Now what differentiates loss? Your AC curve will be above your AR curve. That's all. As usual, draw your horizontal line, price equal to AR is equal to MR. Then draw your MC curve. See whether the two conditions are met. Fix your equilibrium position point. Drop down to find out the equilibrium output. Drop here to find out the equilibrium price. Now locate your AC curve. ATC curve is this. Okay, ATC curve is this. Now look at MC passing through the minimum point. MC passing through the minimum point. Now look at your ATC or AC. Cost is at B. Revenue is at E. AR is here. AC is here. So which is above? AC. AC is greater than AR. Okay. So if you say DQ is my AC, then EQ only is the AR. This difference BE is the loss per unit of output. So what is the total loss given by the shaded area in the figure? PABE. Okay, or ABEP, whatever it is the loss per unit. Okay, three conditions. So that is what is happening in a perfectly competitive market in the short run. Do you understand, students? Long run, what happens? In the long run, look at it. In the long run, there will be only normal profit. What is a normal profit? There will not be any difference between AR and AC. So you look at your AR equal to MR. Draw your MC. Draw your AC. Look at this point. Yes, somebody is asking a question.
Normal profit means expense equals revenue, ma'am. Cost equals revenue.
Yes, AR is equal to AC.
Okay.
Okay, it's otherwise also known as zero economic profit. It is called as a normal profit or zero economic profit, where your AR will be equal to AC. When AR is greater than AC, we call it as supernormal profit. When AR is less than AC, we call it loss or loss at minimum. Are you clear? The three situations? Students, please note the two equilibrium conditions, same for all the market structures. See, once you know for this, it becomes easier. Look at this. That's why I repeated, I put it in bold. The two equilibrium conditions and see profit situation. This is AR and AC. Where is that given to you? Yeah. The beginning itself. Two conditions for equilibrium and three possibilities for profit. Look at this. AR is equal to AC is normal profit. AR greater than AC is supernormal profit. AR less than AC is loss. And two equilibrium conditions. Repeatedly I am telling you, okay? And just because we are in the equilibrium position, it doesn't mean that the firm is making a profit. To know whether it's making supernormal profits or incurring a loss at minimum or only enjoying normal profit, the introduction of a tool called as AC is very important. So we compare our AR with AC and accordingly tell. Okay, so in the short run, in a perfectly competitive market, three possibilities are there, whereas in the long run only one possibility. What is that? Normal profit. Look at this. AR is equal to AC. Draw your MC curve. Fix your equilibrium point. Give your equilibrium output. Give your equilibrium price. See where your AC is. Yes. So what is happening? At this point, AR is equal to AC. So it is a situation of normal profit. Look at this. Firm makes normal profits. AR is equal to AC or ATC. Is that clear, students? So a little bit of rationale as a note I've added. Please go through. It will make you remember the curves much better. Is that clear? Yes, are you clear? Yeah. One more point which I wanted to tell you here is shutdown point. Small note. So where is my shutdown point? A small note I wanted to. How do you identify a shutdown point? Look at this. So students, look at it. Generally we said no, cost is comprised of fixed and variable cost. So variable cost plus fixed cost is equal to the total cost. Now supposing you find that when the firm is able to cover full of variable cost and a portion of the fixed cost, it can continue even though it is making a loss. Why I call it making a loss? Because full portion of the fixed cost is not covered, therefore it is loss. So the firms, as long as they cover full of the variable cost, look at this, variable cost is fully covered. When fixed cost is partly covered, the firm can continue. Okay, the firm will continue in the short run, because by operating the business, it is able to cover more than the variable cost. And remember, fixed cost, whether you are running or not, it has to be incurred. So when I am able to run the firm and covering whole of the variable cost plus a portion of the fixed cost, it is beneficial for the firm to continue. Okay, but when is a shutdown point chosen? Shutdown point will be chosen when even the variable cost is not able to, when the firm is not able to cover even the variable cost. So better I shut down, because when I shut down, there will not be variable cost at all. Okay, what is a variable cost? A variable cost is a running cost. It's an operation cost. It's a cost which is incurred with the variations in the level of output. So at least I can, when I shut down, there will not be this variable cost at all. So when even the VC, or that is average fixed cost, is not getting covered fully, there will be a temporary shutdown.
Ma'am, an average variable cost is just equal to average revenue. Can we close the firm or?
Please be clear, ma'am.
Ma'am, when AVC equals to AR, AVC equals to AR, we need to close the firm or we can continue the firm?
That is what, at that time, you do not have to close. You need not have to close. See, here we are talking about a scenario when the firm has to decide about the shutdown. So when it has to decide about the shutdown is what is discussed here. The answer for your question is break your cost into fixed and variable cost. Okay. Now, what is the loss when I'm not able to cover the whole of it? So it's already loss. Now, if I'm able to cover variable cost fully and a part of the fixed cost, if the firm is able to cover whole of the variable cost and at least a part of the fixed cost, it will continue. It will continue. Though it is loss. It is a situation when you are not covering your cost fully.
Ma'am, I am asking for a situation in which only a variable cost I am covering, but I am not covering the fixed cost, not even a single penny from that point. So then we should close the firm, no, ma'am?
That is anyway. See, that is like when the variable cost is covered, fixed cost not covered. That's what you're saying, right? Is it?
Yes, ma'am.
Yeah. Now, this is a case where the firm can decide what to do. So variable cost is fully covered.
Yes, ma'am. Variable cost fully covered, but fixed cost not nothing covered, ma'am.
Nothing covered. Which means what? Supposing I shut down. then my variable cost will also go off. No, I will not have that. So it can shut down as well. Okay, because there is
Okay, ma'am.
no difference. No, see, I will run and I will cover my variable cost. That's the idea. When I run, I will cover my variable cost and some portion of the fixed cost. That is the rationale for continuing of the firm during a loss. Please get this point very clearly. I will continue at a loss when I am able to cover the variable cost fully and part of the fixed cost. Now your question is, they are covering variable cost fully, nothing of the fixed cost. Okay, so what to do? What can the firm do? If I continue, also no difference. If I shut down, no difference. So it depends upon the criteria there. I am telling about a case where a little of the variable cost itself is not covered. Fully you have to no choice here. There's no consideration here actually. At least in your case, they have to think. Okay, so yeah, they are able to cover the variable cost fully. So they can think why they are not covering the fixed cost, what to do or this. I am telling a situation where even the variable cost is not getting covered, which means what? They have to shut down. So look at this shutdown option.
Okay, ma'am.
You see himself not getting covered fully. Very dangerous situation, right? So they have to be a temporary shutdown. So mine is the worst case which I am telling to you. Okay, students, are you clear?
Yes. Yes, ma'am.
Okay. Okay. So now let us go on to the monopoly. Okay, topic of monopoly. Let me just click in monopoly. So in mono, what is mono, what is poly? Please be clear about that. What is mono, what is poly? So that is very important. What happened to my division folder? Where are you, my dear? Okay, I don't want this. I don't want, yeah, this is what I need. Yeah. So now we are going to go into this. So 1 minute, students. I'll get back in 1 minute to you.
I can't hear you, ma'am.
Yeah. I'm just going to start now. Hello. Hello.
Yes, ma'am.
Yeah. Now, just please understand, students, we are going to next market structure monopoly learnings from this lesson. We are going to see this. Now, prior to that, one of you was asking a question. Please remember about that shutdown point very clearly. See if the AVC is fully covered. If you are running the organization, you are covering it. If you are not running, you are not going to incur at all. So depending upon other factors, they have to decide whether they can run or not. Okay, it will not have a any make any difference, because I run, I cover the expenses. I don't run, I don't incur. That is the situation of AVC. But where comes a question of shutdown is where I don't even cover variable cost. And when is a situation where in the loss I am running, I cover ABC and a portion of the fixed cost. Okay, students, be very clear with that. I wanted to tell you that by the time I went to the next lesson. Anything very good that girl asked that question. Okay, come to this monopoly. Look at this features of monopoly. Very question mono. See, I've given as key points. No, they are very important. Monopoly, absence of competition. Mono, single, polane, is seller. Even in the previous topic we segment, it was there. No, that itself is a very important question, students. Monopoly, oligopoly, all this, please remember those terms. Okay, the Greek terms and the meaning of the term mono, geo, oligo. And oligo is asked more often. Few, oligo means few, and poly or polane means seller or to sell. Okay, so have that single seller component. And all these features of monopoly I have given to you, because again incorrect and correct sentences for which this has been given. Okay, single seller, absolute control of the market. So he is here price maker, not a price taker. Okay, remember that. And absolutely single control, okay, over the market as such. And remember, here you will find that in this case the domination by that monopolist will influence the market to such an extent that he will be in the position to determine the price of the commodity. Okay, some examples of monopoly I have given for you to understand what a monopoly is. And private, different types of monopoly. So private monopoly, that monopolistic control which is found in the private sector. Public monopoly is government having that control. Pure monopoly is no substitute at all. Absolutely, there will not be any substitute for that. That is pure monopoly, but this is only a theoretical one. But simple monopoly is a real one. Okay, where you find a commodity having a remote substitute. It is not a closed substitute but a remote substitute. Discriminating monopoly, where different prices are charged from different customers. And based on what criteria? Different prices may be charged based on ability to pay, in which case it's called as personal discrimination. When different prices are charged from different customers for the same commodity or goods based on region or locality, then it is called as price discrimination. And trade or use discrimination, here the discrimination is done based on type or uses. Please note price discrimination, this discussion is very important. This is a very important discussion. It's a very important discussion. Please note that. Okay, price discrimination types: personal, place and trade or use discrimination. Okay, please note the criteria has been highlighted in bold: ability to pay, regions or localities, and user purpose. Okay, all three are important. And this is an added segment which I'll give you long back. Once they gave this degrees of price discrimination by Professor Pigot. Long back I gave you one paper I saw, but after that it's not been asked. Price discrimination of the first degree, second degree and third degree. It is given by Pigot. Now can I ask you one thing? In our yesterday's revision session, we saw the name of this economist. Can anybody tell me in what context or what is that we knew about or learnt about this Professor Pigot?
Can you say again what you asked, ma'am? I didn't hear.
This name of this economist we studied yesterday also in our revision segment. What is the core point which was told about this economist?
Don't know, ma'am.
Father of welfare economics.
Wow, that's very good. Father of welfare economics, who said, how did you recollect? So much of attention you're paying. I thought Shashank will certainly reply, but he disappointed me. Actually, I thought he will be the first one to reply actually. But anyway, very good. Some of you at least noted. Now and then, recollect. Now from there you have to go, okay, who's the father of economics, father of classical economics, father of macroeconomics, father of neoclassical school. Recollect like that. As you study, keep recollecting. Okay, price discrimination of the first degree, second degree and third degree. So here discrimination, how is the price charged? Here maximum amount which a consumer is willing to pay rather than without the commodity is the price which is fixed in the market. So which means nobody will have consumer surplus because the maximum price which people can afford is being the basis for fixing the price. Now under price discrimination of the second degree, they will locate the poorest member of the community or the society and ask that segment what price they are willing to pay, and that will be fixed. So except for the poorest member, others will enjoy consumer surplus. Can you follow? Then price discrimination of the third degree, here prices are fixed according to the demand in the particular market. So here if you take this as one market 1, in that market the demand and supply equilibrium interact. Supply is a straight line, vertical, parallel to your y-axis. So according to the demand, price is fixed. Here in the second market, denoted by D1 demand, you find that the price is higher at P1. Just a minute, students.
I'm not able to hear you.
Yeah, sorry, I muted myself because I started coughing. So remember the students here, 3 types of price discrimination as given by Professor A.C. Pigo. But of the 2 segments, this is the most expected question. Okay, so go through types of monopoly with example, go through price discrimination of the 3 types. Is that clear? Yes. Then coming to the next one, conditions for price discrimination. Okay, so there should be some monopoly power or some control dominantly evident. Then you can call him as an monopolist. And the seller will be able to divide his markets into sub-markets so that he can practice price discrimination. Okay, and the price elasticity of the product will also be different in different sub-markets depending upon their income or locality or whatever it is. Okay, so these are some of the conditions so that it will be possible for the buyers. The market will be such that it will be possible for the buyers of the low priced market to resell in the high priced market. That will also happen in a monopoly market and all. Okay, and what gives a monopolist the power? Power by the government, legal power through trademark or patent rights or copyrights, technical power because of the technical know-how or superiority or special know-how, combination because joining together, 2 or more join together and have a single control channel. Okay, and bias of the consumer. Is lazy or ignorant of the commodities or the requirements of him available at lower price, and therefore that will also lead to the growth of a monopolist. Okay, so what confers monopoly power? Look at it: power given by the government, legal power, technical power, combinations, and bias of the consumer. Coming to the price output determination, please look at this. This is the premise of it. The monopolist can fix either the price or the quantity. That is the logic. That's why you find your AR curve coming down. It's not a straight line parallel to the x-axis like your perfectly competitive market. In case of monopoly, you find it is a downward sloping case, a curve. The reason is this. Because see, he wants to charge a price OP0, which means he can sell only at OQ0. Suppose he wants to compromise the price, he is willing to sell at OP1, then he can sell more. So look at the statement, a fortunate monopolist can fix either the price or the quantity to be sold. Do you understand, students, why we are having downward sloping curve? Because look at this, the buyers will take up larger quantities at lesser price. Okay, now look at the conditions for equilibrium. Remember, students, this is the same for all market forms. No difference in the equilibrium conditions, no difference in the profit conditions. Okay, look at this, MC is equal to MR. MC curve cuts the MR curve from below. Almost in every year this question is asked, so please note it as important. Now see, look at the shape of the curve. AR is sloping downwards, MR is also sloping downwards. This is what we saw in the revenue chapter. Do you remember? AR will be coming down, MR will also be coming down, MR will be below AR. Okay, so look at this, AR is down, MR is down. I am drawing my U-shaped MC curve. So what are the two equilibrium condition? MC must be equal to MR. MC curve must cut the MR curve from below, which is met at point E. I take the curve up to meet the AR, which will give my equilibrium price, which is fixed at OP. I drop the line down from E to the point Q, which determines my equilibrium output. So my equilibrium output is OQ. Study in that way, okay? And what is are these conditions sufficient to say whether the monopolist is making profit or no? No. So what do we need? We have to consider two tools, AR and AC or ATC. So now look at it. Case 1, I've given you as case 1. A firm's equilibrium and monopoly, super profit condition or maximization of profit. Look at it. AR, drop the AR curve down. You have an MR curve downward. You have an MC curve going upward. So you are fixing your E point here. MR is equal to MC. MR is equal to, this is the equilibrium point. Okay. MR is equal to MC. Drop down the curve. Determine your equilibrium output at OQ. And now take it to your AR curve. And what is your output? What is your equilibrium price? OP or AQ. That is the price. Okay. Now what is that we need? We need ATC. Look at my ATC. Look at my ATC and look at my MC passing through the minimum point of AC. So look at my ATC. So my AR is at point A. My ATC is at point B. Look at it very clearly. My AR at A. My ATC at B. So AR is greater than ATC. So it is a case of supernormal profit. And remember, my examples are very brief and clearly given to you, the explanations. So you don't have to hunt your parent institute material for explanations. Diagram explanation in a crystal clear manner is given. Is that clear, students? And the small diagram I gave to make you, to remind to you or alert you, saying that, remember the property we learned under cost curve, what we revised, MC curve will pass through the minimum point of AC curve. I didn't want you to miss out that point here. Probably here in so many curves you may miss it out. That is why separately a small curve, a mini curve has been given to you to tell you that MC curve passes through the AC curve through its minimum point. Look at this, this is a minimum point. Okay, so PQ1. So this is a case of your AR greater than AC. Now this is a very important point. Jot it. Very important one. Can a monopolist incur losses? Generally, we say that monopolist, we associate him with a person who will never make loss, which is wrong, because business is always associated with risks and uncertainties. Even though you may be a strategic businessman, losses are inevitable. Okay, a business project may be adventurous, so you may take it up, but he is bound to face a loss. Okay, and what is the situation here? Your AC or ATC will be greater than AR. Cost is greater than revenue. That is what we are showing here. Draw your AR curve, MR curve, MC curve. The intersection point gives your equilibrium point. Bring it down. This is your equilibrium output. Take it to your AR curve. That determines your equilibrium price. OP or BQ is the equilibrium price. Now, where is my AR? Yes, at point B I can see Where is my AC? I draw my AC curve. My MC is passing through the minimum point of AC. In that way only it is constructed. So my ATC is at this point. My AR is at this point. So clearly it's a case of ATC greater than AR. Therefore it is loss. That's it. So this is your loss. So PCAB or PBAC indicates a loss situation. So monopolist can incur loss. Okay, this is a short run position. Do you understand, students? Now, what is happening in the long run? What is happening in the long run to a monopolist? In the long run, the monopolist will be making profit only. Whereas, look at simultaneously, I have shown you perfect competition. In perfect competition, what is happening? AR is equal to ATC at this point. Therefore, normal profit or zero economic profit. Whereas monopoly, look at this, AR is greater than AC. Look at this. Therefore, it is supernormal profit. So, long run is a period long enough to allow the monopolist to adjust his plant size or use his existing plant to the fullest extent so that he maximizes his profit. He maximizes his profit. So, since there is no competition, the monopolist need not produce at an optimum level. It's not needed. He can even produce at the suboptimal level, no problem. But he will ensure that profits are maximum. So here look at the difference between, parallelly I am showing you this. Okay, in the short run, he will make profit or loss. In the long run, he will be making profit only. Can you understand, students? In the long run, he will be making profit. Okay. Is that clear? So as usual, if he is not able to meet even in the average variable cost, if he is incurring a loss in the short run and he finds he is not able to meet even the variable cost as such, he will shut down. He will not continue. So in the long run, the monopolist will make profits. There will be maximization of profits. So look at the conclusion. The monopolist will not continue if he makes losses. Okay, and he continues to make supernormal profit. He continues to make normal profit even in the long run, as no new firms can enter in the case of, as in the case of perfectly market. He continues to make supernormal profit because there are no new firms coming, as happening in the case of perfectly competitive market. So in short run, profit or loss. In the long run, profit only. Have you all understood, students? Is it clear? Can I go to monopolistic competition? Can I go to monopolistic competition? Are you able to hear my voice?
Yes, ma'am.
Yes. Good. Hari has replied.
Yes, ma'am.
Okay. Somebody is also shouting on top of a voice. Very good. Okay, let us come to a very beautiful lesson, monopolistic competition. Learnings from the lesson. Meaning and its features, product differentiation, non-price competition. See how we are introduced to new terms. What's a monopolistic competition? Blend of the term monopoly and competition. It will have features of both. Please note it. For any form of market structure, the name of the market structure itself is a template question. For any form of market structure, the term itself is a template question noted down. Monopolistic competition is a blend of monopoly and perfect competition, so it will have the features of both. Is that clear? It will have the features of both. Okay, so here it is producing commodities which are not homogeneous. Okay, which are not homogeneous but close substitutes. They are not identical products. They are not homogeneous. However, some differentiation is shown. Okay, so product differentiation is there. Please read the key points for correct and incorrect statement. Knowing the correct and incorrect statement, they are not homogeneous or identical but close substitutes. Note that. Okay, so they will be relying upon the brand to differentiate the product. So if it
Ma'am,
is
roads got example தரீங்களா monopolisticல? ஒரு example.
monopolist,
Yes, monopolistic.
monopolistic competition. Look at, we started with
Goods.
an example. Look at this toothpaste segment, cosmetics.
Okay, ma'am. Yes, ma'am. Understood, ma'am.
See, these are monopolistic competition where you can show the difference through adding some features. All those things, all your cosmetics will come under this. No, we will say, no, why toothpaste is the best. It's an economist example. I'm not adding as a commercial part. It's an economist example actually. See, you can show a toothpaste with neem flavor, the other one without it, clove. That's how you're differentiating. All the purpose is they are not identical, but they are close substitutes. So cosmetics and all, very good example for this. Okay, so remember that where you can show differentiation it's possible, that will become what is that, monopolistic competition. Okay, in monopoly, when we study the types of monopoly itself, remember, no, you had examples like Indian Railways, where only the public sector is there, or where only one private stall is there, for example in a village, like that. For monopolistic competition, where variation in brands is possible, all those commodities will come under a case of monopolistic competition. Is that clear? So large number of buyers and sellers. So since large number of buyers and sellers are there, individual control by a firm is not possible, which was happening in monopoly. Okay, large number of sellers are there, and therefore through product differentiation, where and all product differentiation is happening, there you can say, you can bring them as a case of monopolistic competition. Okay, look at this implication of product differentiation. Please read this segment, students, please read this segment very properly with examples. Toothpaste segment, Pepsodent, Colgate, Neem. Cycles, Atlas Cycle, Hero Cycle. Tea, Brook Bond, Tata Tea, etc. Soaps, Lux, Hammam, Lifebuoy, Pierce, etc. Okay, now what is this product differentiation? To enable the monopoly, the seller in a monopolistic competition to enjoy monopoly power. Read this implication segment, you may be asked in MCQs. Okay, how you differentiate the product through different brand names. Product may be soap, but with the brand name you can differentiate it, and this differentiation can be imaginary or real. Note this point. What is an imaginary, what is real? See, real difference is this: you bring about through flavor, adding a flavor, adding an ingredient, giving an after sales service, some warranty, extension of the warranty period, in terms of packing. All these are called as real differences. Okay, those are real differences. But what is an imaginary differences? Actually there are no difference, but the consumers are made to believe through advertising. Oh, my product is superior, my company's product is this, all those through advertising, for which they are incurring a selling cost. Okay, so real, imaginary differences. So product differentiation creates a monopoly position for a firm in a monopolistic competitive market. Can you understand, students? It's very, very important. Look at all these examples. Be clear with the examples. Wherever you can differentiate through the brands, this will come into existence. Okay, monopolistic competition. Therefore only we are saying selling cost plays a very important role in monopolistic competition. Selling cost. Selling cost refers to expenses incurred on marketing, sales, promotion, advertisement, etc. In perfectly competitive market, do we have selling selling cost? There are no selling cost. This part, note this part, for your understanding and learning of the market structure, this part. In perfect competition, no need for selling cost. Why? We gave already a condition called as perfect knowledge among the buyers and sellers, and already it's homogeneous product and uniform price, so the necessity will not be there. Under monopoly, to inform people, a monopolist will incur a small amount of selling cost only for informative purpose. Okay, and in case of monopolistic competition, it will be incurred at a very huge level. Are you understanding, students? It will be incurred at a very huge level. So there is a term we use in monopolistic competition called as non-price competition. Note it as important because you may not be familiar with it. We have seen price competition, price war. Non-price competition refers to competing with firms by offering free gifts, making favorable credit terms without changing the prices of their products. That's all. In price, I'm not going to make any change. I'm not compromising. What am I going to do? Where is the business strategy? Offering some gifts. You buy one, get one free. So you can buy on installments. You are getting some credit facilities. So many buyer facilities are being given here. Okay, so that is called as non-price competition. Note this, you may not be familiar with non-price competition as a term. That is why I highlighted and give, and different ways I'm giving. Okay, students, understand. They will not bring about all strategies except cut in the price of the product. Okay, so look at, that's why I inserted a slide also. Involves advertising of the product's appearance, quality or design rather than its price. So through advertising, you're making the consumer believe the product is different and it's worth the price. You can even fix a very high price because you are making the customer buy through your promotional strategies. You are making the customer believe that it's worth buying the price. We saw yesterday one example, price delusion. High price is associated with high quality. So you are making the consumer get the delusion. Probably it's of a very high quality. That's why the price is so. So the promotional strategy will be to that extent. Understood? Clear? Okay, that's why I'm giving you. So look at the other features. Free entry and free exit. It's looking like your perfectly competitive market. Here another features have been added is lack of perfect knowledge. It's not possible because the market is huge. In fact, the buyers and sellers, it's very difficult, particularly from the buyer's perspective. If you take, because of too many goods flooding the market, it's very difficult. It can be anyone's personal experience. As a consumer, you will know it's very difficult for you to know the which is a good quality product or what you should buy. Okay, that is there. And pricing decision, what you have to know is a firm under monopolistic competition is neither a price taker nor a price maker. However, by producing a unique product or establishing a particular reputation, each firm is said to have what is called as a partial control over the price. And the extent of this control depends upon the brand loyalty of the customers. Okay, so it's a very, very tricky kind of a thing. You cannot be a price taker or a price maker. It will be like, I try to promote my product, I try to promote through different strategies, and depending upon how well it's received in the market, accordingly the position of the firm in a monopolistic competition will be. Do you understand, students? So have you noted down all these things? Are you clear? So that we can go to price output equilibrium in this market. Are you clear with monopolistic competition? Do you know what are the points you have to note it? So note all these points with clarity. Okay, now let us move to the equilibrium price output determination. One good news here for you is it has lots of similarity with monopoly. In fact, it's totally similar, but for the flatness of the curve. The difference between monopoly and monopolistic competition lies in case of monopolistic competition, AR will be flatter. Here it will be steeper. In monopoly it will be steeper. Oh, somebody is making lot of. Note the difference, students. So 1 hour more today you have to stay. Will you do that? Shall we finish today's target? Now it's 1:25, 12:25. No, 1:25. Please be prepared to stay. Will you do that?
Ma'am.
Yes. Yes.
Yes, ma'am.
Continuously 125. Will you give break up?
I'll give break. See, when you ask break, I'm prepared to give. because I will not dump upon you. So the moment you ask me break, I will give the break.
I think I'll not be able to attend. I have college class at 1:30.
Okay, okay. Then till what time you'll attend?
Don't know, 1 o'clock or what.
Till 1 you'll attend. Okay, okay. I cannot say anything, no. It is, see, the revision is basically done for you to know, have a quick glimpse of everything. It will help you, yeah. The more you listen, the more you register, the more you keep writing, no. It'll stay on the day of the examination. You believe me or not, trust God, I swear. All these things will come to your mind. And because most of the students, most of the time students have got back to me and told, ma'am, this is what, ma'am, what you told is correct. We remembered, ma'am. Seriously, they come and do share actually. So that's why I'm saying, okay, already a video lecture is given. They have given notes. They have given material. Why again? No, don't think like that. Maximum number of times you are going to listen to this. Easier for you to recollect. It's a basic agenda of exam revision.
Tomorrow we can have no, no. Tomorrow
Yeah,
no, college classes are there. No. We can have 1:30 or 1 up to 2 also we can have. Today only problem.
yeah,
That's it.
yeah, yeah. Tomorrow I can also have. Tomorrow, no, see, they have scheduled, no, accordingly they are giving time. I am seeking. I have told that I need half an hour more, something like that. Only I am asking because they have given me till 1, but I am asking till 1:30, and I told them that I want to. I may go little beyond to complete my portion. Yeah, tomorrow we will have that little beyond we can go. But today also I'll be going till 1:30. It's very important for me, no? So we have to cover sizable portions. Okay, so don't worry. We will, as far as possible, let us see. From two sides we have to work and we have to learn.
Only for today can we have up to 1 hour, please.
Seriously not, because at the end of the day I have to report stating how much of it I covered, because I have to cover, see, oligopoly, and I have to cover economies of scale. See, today only take a break from college, no?
Daily I'm taking some. That's why I'm
Daily you're
asking.
taking.
Yes, ma'am,
Daily
daily.
you're taking. See, 1:30 only your college starts. Where
No,
college
ma'am,
ends?
they start at 9 o'clock, ma'am. From 9 to 1, 9 to 2, ma'am. They always go 9 to 1:30. Then 1:30 one college class will be there like that. That's why I'm asking.
Oh, okay, okay, okay. Then today you have to view the video lecture for the rest of the part, I think. Because I'm told to, and they have given me today also. I've taken permission from the management. They have told me they have already allotted me half an hour extra. They said you can take, uh, don't worry. So having taken that, no, told them also, because yesterday I understood I cannot, dot at 1 I can't close, because we may be discussing certain things and I cannot stop like that. So today also I've asked till 1:30, and they said yeah, fine. So that is why I'm going.
Ma'am,
Try now today to stay till 1:30. You try. In college, you say that from Monday you'll be very regular.
excuse me, ma'am.
Yes, yes,
Ma'am,
Srivatsa.
ma'am, when will you send the notes, ma'am?
The on Sunday I'm finishing. No, Monday it will get posted because I
Okay.
want to post. I want to attach uh, question papers chapter wise with the solutions I've given. MCQs type I've made for all topics actually.
Okay.
So this revision lecture will able to understand why this option is chosen. So when you see, you will understand. Oh, okay, this is why this is the option. So you will again understand that. So I am planning to release it on Monday, because
We will
till
send
Sunday
this
I'll be.
revision lecture to.
Revision lecture yesterday's I've already uploaded. No, I mean, what do you ask? Video you're asking? Huh?
No,
What is
ma'am.
it you're asking?
This notes, ma'am.
Notes. Yeah, that's totally all thing will be notes as such, with the chapter wise insertion of question paper will be given on Monday.
Okay. Thank you.
Okay. Yeah, sure, sure. Okay, so I will do monopolistic competition, and after that I'll give you 5 minutes break actually, because I cannot dump oligopoly upon you. So let us do this monopolistic competition, price output determination, equilibrium price output determination. Now look at this curve. Is it reminding you of monopoly? Is it not reminding you of monopoly? Certainly yes. It will be reminding. Look at the difference also. See, then and there we are placing in front of you. In monopoly, the two curves are the curve is steeper. Here it is flatter. That's the only difference. And why this steepness and why this flatter? For this also we have an answer, because in monopoly the demand is said to be inelastic because single control. Here the AR curve, which reflects the demand scenario, it tells you here the demand is elastic because if one brand is expensive, people can switch over to another brand. If Pepsodent is expensive, people can switch over to Colgate. If Lux is expensive, if Dove is expensive, people can go to Lux. So this curve, the flat nature of this curve is because of the elastic nature of the demand prevailing in a monopolistic competition, because there are large number of sellers offering their products with differentiation. So when one goes up, we can switch over to another. The choice is not here. So this steepness reflects inelastic demand. No other go to that person only, we have to go. No other go, we have to go to that person only. So that is why I am giving you the reason why the shape of the curve is also, and I have also put here for you. Now look at this. What is happening for a monopolistic competition in that?
Ma'am,
Yeah.
I asked the college, ma'am. They are not accepting.
They are not accepting now. Why are they so strict here? They, for a professional student, can they be little lenient? Because it's a very
Excuse me,
important
ma'am.
area. Yeah. Yes.
Is there any live video class in YouTube? This lecturing.
This is uploaded. Yesterday's has been uploaded. Likewise, today I will upload. Today's
Uh,
also I will upload. Are you
which channel,
asking?
ma'am?
It is posted already. You all didn't see here.
No,
In
ma'am.
Bharadwaj channel. Oh, you're yet to see that. Okay, I've already uploaded yesterday's. As soon as I did it, I've uploaded it. Today's also they have given me a Bharadwaj channel where I've
Okay,
posted.
then he can watch it later on that, ma'am.
Yeah. That is always there. Okay,
Uh,
that option is there. Not a problem.
he can
Yes.
attend in that YouTube channel.
Yeah, yes, Shashank, this Hari's suggestion, do you find it worthy? Because he says, no, since it is uploaded, if the college is very strict, not giving you, chance to even, for professional students, and what else can we do? Either we have to understand or they have to understand. I think for you, from both the sides, you are supposed to work hard. But it's okay, don't worry. You will be able to do well. As Hari has suggested, you can watch the YouTube lecture later on also. But why we will not like to miss Sashank, Hari? Because he will participate in the class. He will make us feel it's live session. That's why. Yeah, channel I will let you, because I have already uploaded in the channel thing they gave me. So let me then ask the management how is it to make it visible to you. Okay, in the playlist, what is called as Grand Revision 2020, we have already put it in the playlist. Probably we will share it in your Google Classroom as we do the notes, no? I think that is how we have to do it for you. We will share it in the Google Classroom. Yeah, I will inform management. Already in the playlist I've added yesterday's thing. Okay, Grand Revision CA Foundation 2020 Economics. It's already there. So we will post it in the classroom. I think that will
Okay,
be
ma'am.
helpful to you.
Okay,
That
okay, ma'am.
yes. Thanks that you asked it. No? So it is helpful for others also.
I'll manage with the class, ma'am. No problem.
Will manage. Very good. Okay. So now look at this difference. AR and MR. Look at the shape of the AR curve in monopoly. Shape of the AR curve in the monopolistic competition. Otherwise, but for the steepness and flatness, the AR will be sloping downwards in monopolistic competition also. MR will also be sloping downwards, and it will be below AR. Understand that much, okay? This is very, very important for you. Please note it. In which competitive market it is flat, in which AR is steep, that you must know. I also gave you the reason of why it is steep and why it is flat. Okay, wherever possible, I am adding explanatory notes so that you recollect that in the examination. Okay, that's very important. Now go to this one. This part is very easy. By now you should be familiar. We saw in the perfectly competitive market, we have seen in the monopoly market, you are seeing in the monopolistic competition. Case 1, I have given as case 1, case 2 or case 3, whatever is the scenario, short run separately, long run separately. Look at this, two equilibrium conditions, recollect that MC is equal to MR and MC curve cuts MR curve from below. Okay, and what is the condition that determines whether the firm is making profit or loss? You have to use AR and AC tools. Okay, AR greater than AC is supernormal profit, AR is less than AC is loss, AR equal to AC is normal profit or zero economic profit. Please be very clear, oft repeated. I'm hinting again and again in every market form, I'm hinting you that. Okay, now go to the diagram. Similar, don't you find it similar to monopoly? Except for it's a bit flatter because it is a case where there are number of sellers offering their brands, their products. So if the price of one is high, the consumer will go for another. So it represents the elastic nature of demand. In monopoly, the steep AR curve represents inelastic nature. So AR is coming down, MR is also coming down. Okay. So look at this, AR is down, MR is down. Okay. So just now, students, I'm going to give you a break for 5 minutes and we'll get back. Okay. You can, those who are able to stay on, stay on. So I am giving you now, it is 12:40, no? So will you get back at 12:45 or you need till 12:50?
12:45, ma'am.
12:45, okay?
Yeah.
Oh,
Okay.
very good.
Mm.
Thank you. Monopolistic competition. So let us quickly understand the diagram. Look at this. AR is sloping downwards, MR is also sloping downwards below AR curve, and look at your MC curve, U-shaped MC, intersection of it at point T, drop down, get your equilibrium at OM, equilibrium output, take it to your AR curve, and you are getting your equilibrium price fixed at OP or QM. Now where is my AC? My AC is here. So look at my AC curve and remember your MC curve is passing through the minimum point of AC. Now where is my AR? At point Q. Where is my AC? At point S. So AR is greater than AC, which reflects a situation of supernormal profit. Look at this, and this, please remember students, this crisp explanation is enough for you to and address any question on it because it's very clearly given to you. Okay, short run case 1 was supernormal profit. Short run case 2, what is case 2 short run? You will find that the firm incurring loss. Short run case 2 is firm incurring a loss, and here let us understand, here again let us start with recollecting the two important equilibrium condition. MC is equal to MR and MC curve cuts MR curve from below. And what is our profit or loss condition? AR greater than AC is supernormal profit, AR less than AC is loss, AR equal to AC is normal profit or zero economic profit. Now what is happening here? So we are going to show the situation of loss. So everything will be the same except for the placement of your changing of AR and AC.
By cost, you mean expenses only, no, ma'am?
Can you ask, please be louder?
Ma'am, by cost, you mean expenses only, no, ma'am?
Yes, expenditure. Yes, definitely expenditure. So please have a look at this. So look at your AR, your MR, your MC. Look at this intersection. See whether the two equilibrium conditions are met. Drop down your curve. You have your ON level of output. Where is my AR? I take it to AR. I determining my equilibrium price, which is TQ or EN. Okay, now this is my AR. Where is my AC? So AC is at point H, whereas AR is below that. Okay, so AR is below that. I think it is K, point K, which is given there. So you find that your AC being greater than AR, you call it as a loss situation. Okay, this shaded area, okay, which is nothing but GHET, gives you your loss situation. Is that clear? Now these are the two probabilities. In the long run, what will happen? In the long run, you will have only normal profit. Look at this diagram. Normal profit means what? Your AR will be equal to AC. Look at my AR sloping downwards, MR sloping downwards, MC curve going and intersecting. You are plotting your equilibrium at this point. You are taking it to AR, determining your equilibrium price at OP, and you are dropping it down, determining your equilibrium output OQ1. Okay, now look at AC. AC and is equal to AR at this point. Therefore, it is normal profit in the long run. Now, dear students, please note one important point for a long run in monopolistic competition. This long run normal profit situation under monopolistic competition is called as a group equilibrium model. Jot it down if you, so that writing will make you remember from the examination point of view. Do that. And here this long run equilibrium is possible because of certain assumptions which are called as heroic assumptions of uniformity as given by Professor Chamberlain. So a long run group equilibrium model is based on heroic assumptions of uniformity and propagated or proposed by Chamberlain, Professor Chamberlain. And here you will find normal profit situation. Here what is happening is the monopolistic competition players, they understand that if they act together in unison as a group, then they will be able to win the market. So individually if they act as competitors, there is in all probability they may be losers, and therefore according to Chamberlain it is better that they act in group so that they are able to win the market. So look at these heroic assumptions. So in uniformity, that is, they will be producing more or less similar product, and they will also have equal kind of efficiency equal cost, and regarding technology also they are trying to ensure that all of them are working in equilibrium. So it is called as heroic assumption of uniformity. Do you understand this point, students? So in the under monopolistic competition, based on heroic assumptions of uniformity as given by Professor Chamberlain, we are having a situation called as long run equilibrium, normal profit. Okay, this was not there in any of the previous market structures. And one one diagram I've added just to say that in monopolistic competition there will be wastage. Look at this. Two curves. Look at this curve. I've given you this curve to tell you that in case of a monopolistic competitive market, look at this AR and MR. Okay, MC, AC. Look at the minimum point. Look at where it is, where this is located. AR and AC is located here, whereas the minimum point is here. So the above graph will tell you that the long run equilibrium of a monopolistic competitive market where your average revenue curve touches the average cost curve at point T corresponding to the quantity Q and the price P. Now at this price, fine, MC is equal to MR. Okay, MC is equal to MR. But you will also understand that there is an excess capacity which is getting wasted, which you call as defect of monopolistic competition. Instead of producing this much, we are producing only this much. There is a capacity to produce till here. They have the capacity to produce till OR, but they are producing only OQ. So this is called as wastage of monopolistic competition, or what you call as excess capacity. So this diagram depicts excess capacity as a wastage of monopolistic competition. This much they can produce, but they are not. They stop with this, which is called as a defect of monopolistic competition. This I added because long back this question was asked, and after that it was not asked, but certainly I thought I'll put in a word to you. So when you look at this diagram, you will see the difference. So at point T itself, the equilibrium is established, whereas they can produce till the minimum point here. They have that capacity, but it's getting wasted. So it's called as wastage of monopolistic competition. This is referred to as a defect of monopolistic competition. Okay, students. So with this, we are done with monopolistic competition. Let us do oligopoly. Quick revision of oligopoly. Oligopoly is a favorite market structure of the examiner. It's a favorite one. Just look at our agenda. How much have we finished in our agenda? Okay, we did supply, elasticity of supply, theory of cost, theory of revenue, market structures. So you have only economies of scale, not an issue. Okay. Now look at the students learning from the lesson oligopoly market. Be very clear with the market. Okay. So look at this meaning with examples, types of oligopoly, price leadership form, king to demand curve, selected models. Okay, so look at this. Oligopoly is an important form of imperfect competition. Look at the key words, key points. Two Greek words, oligos meaning few and polein means selling. Okay, that's what here. Look at this. It can produce homogeneous products or it can also show product differentiation. Is that clear? And example, usually petroleum sector where you cannot show, see, in monopolistic competition we can show product differentiation, whereas in oligopoly generally that brand and product differentiation is not much done. A big firm will be competing in the market. Take petroleum, now how much of a differentiation you can show? Okay, and this market is a competition among the few, and duopoly is actually a segment of oligopoly where there are two sellers in the market. Okay, and oligopoly, according to the economics literature, the term few denotes anywhere the number of sellers anywhere between 2 and 10. If it is 2, it's a duopoly. So anywhere between up to 10 you can call it as oligopoly. Okay, so in monopoly the single firm enjoys absolute power, whereas in oligopoly a few firms, they try to, either through competition or collusion, they try to dominate the market. And examples of oligopoly industry have given: cool drinks industry, automobile industry, airlines industry, petroleum refining, power generation. All these are examples, common examples of oligopoly. Okay, types of oligopoly. Look at the types of oligopoly. Mark it as important. Types of oligopoly and king to demand curve, specialities, because your types of oligopoly will tell the features of oligopoly market. Is that clear, students? Your types of oligopoly will tell you the features of the oligopoly market. Therefore, read types, read king to demand curve. Okay, so what is a pure oligopoly? So pure oligopoly is where the commodities are homogeneous or identical. Good example is aluminum industry. Okay, so basically this type of oligopoly, what they will do is they will be doing a bit of processing of the raw materials, or they'll be producing intermediate goods, and this will serve as an input for another industry. See, notable examples: petroleum, steel, aluminum, all will come under oligopoly. Okay, differentiated oligopoly is where product differentiation can be done to some extent. Automobile industry or soft drinks industry, or in some kind of differentiation will be done to show that they are not identical products. Okay, closed and open oligopoly, this depends upon the entry and exit. That is freedom to enter and exit. If there are barriers to entry, you call it as an oligopoly, closed oligopoly. If they can freely enter and compete with the firms, you call it as open oligopoly. So it is the barriers to the entry that defines whether it's open or closed. Then collusive and competitive. So what is collusive, what is competitive? So when two or more sellers agree to fix prices and to act together in collusion, so that they win the market, it's called as collusive oligopoly. Act in coordination. Otherwise, if they function as independent and rivals, business rivals, it is competitive oligopoly. Okay, now we also have one common example of collusive oligopoly, that is the Organization of Petroleum Exporting Countries. Okay, it's a group of around 14 of the major oil exporting nations actually, and in fact it was founded long back, somewhere in 1960 or something like that, and they all join together, they coordinate in determining policies relating to petroleum. Okay, they function as cartel. They function as cartel, and through that they do, and then they are not individual firms. It is an agreement between the countries to work in collusion. So usually they give economics textbooks give this as an example of collusive oligopoly, best form. Okay, and whereas in competitive oligopoly, they will be functioning independently as rivals, business rivals. They'll face each other through various strategies. Now, partial or full oligopoly. What is partial oligopoly? Where there is one oligopolist who acts as a price leader and others follow him. That is partial. And what's a full oligopoly? There is no domination by price leader. Okay, then syndicated and organized oligopoly. So what is a syndicated and organized oligopoly? Now, in case of a syndicate oligopoly, there is already a forum which is existing to promote a common interest. Okay, so they have a syndicate or a forum which is established. Okay, so and they are selling or they are planning their activities through the centralized syndicate. Through that centralized syndicate, they are functioning. Please look at this. It refers to that situation where they are selling a product. There is already a forum which we call as centralized syndicate. That is syndicate oligopoly. But in organized oligopoly, what happens is the firms organize themselves into an association. It's not already, a syndicate is not existing. The firms, because of the need of the hour, they organize themselves into a central association for fixing the price, output, or some negotiation on quotas, etc. A very, very subtle difference, students. There's not big difference. So in case of a syndicated oligopoly, where already a centralized forum is there through which operations happen, but in an organized oligopoly, the firms themselves, because of the lack of such syndicate, they organize themselves into a central association and go about the activity. Is that clear? Okay, now characteristics of oligopoly market, they are interdependent because very few firms only, and a step taken by one will influence the other. Step taken by one firm will influence the other. So interdependence is strong. Advertising, we already saw in perfect competition, advertising not needed, and in monopoly just for informative purposes. Okay, in monopolistic competition, advertisement plays a very important role because product differentiation is a key. When it comes to oligopoly, advertisement does play a very important role. They have to aggressive advertising campaign because it's a tough competition among few rivals, business rivals. Okay, then group behavior. So if it is collusive and cooperative form of an oligopoly, definitely group behavior is a predominant feature actually. And they will be having a common group, they'll be having some organization, formal or informal. That's why that OPEC example was given. No, as a group they can function very well actually, and they may be dominated by the leaders. You know, that is also another form actually. And the other feature is sometimes there will be a dominant oligopolist, others will not follow. Okay, then competition. Being a few seller market, the move of one affects the another. Please remember that, few seller market. The influence on the other is, one on the other is prominent. Okay, and barriers to entry, if you just see, in case of open, no barriers to entry. In case of closed, there is barrier to entry. Is that clear, students? So that's what has been given. And remember, there are some types of barriers. How do we create barriers? Because of the economies of scale, because of the control, because of high capital requirements, patents enjoyed by them, a lot of capacity, whatever it is, it's there. Then there can be lack of uniformity because each one will behave individually. There can be a price war, price rigidity. So we cannot determine anything. So indeterminateness will be there. Indeterminate is a hallmark here. Okay, so please be very, very clear. Is that okay? So these are some of the things which you have to know. And in oligopolistic market, price leadership is often, just as price discrimination is there for monopoly, product differentiation for monopolistic competition, price leadership for oligopoly. Look at these key points there. So one of them is a dominant organization who is called as a price leader, and he sets a price, others follow. Is that clear? So the dominant organization is treated as a price leader because of all the examples we saw now, because of large scale economies or advanced technology, whatever it is. And it's very important to have a price leader who can make things more organized. Okay, so cartels. Often we find cartels are formed in industries where a few firms They join together, they coordinate. It happens under cartels. Okay, that's a very important agreement. Cartel is a very important agreement among the firms in an oligopoly market. Is that clear? And in types of under leadership, you have several types. Dominant price leadership, where one organization dominates entire industry. Barometric price leadership is one where and one organization declares the changes in the price. It's able to do an economic forecast and it tells that please fix this price because something is this. So this barometric price leadership takes place due to various reasons. I don't think those reasons are very important for you, but please understand that they will make a forecast and let the others know that this is the price decided by this firm because of an economic forecast. Okay, that is barometric. And aggressive price leadership is one where one organization will threaten the other organization to follow it. Okay, then low cost price leadership is one where a firm which is having a lower cost than the other firms will set a very low price, which other firms are compelled to follow. Okay, these are all the forms of price leadership. Now coming to kinked demand curve, look at this. Kinked demand curve. Please remember students, we don't have equilibrium price output determination under oligopoly market. We are studying only about the kinked demand. What is a kinked demand curve? What is its significance? Kinked demand curve explains one of the important features of an oligopoly market. Now this is the AR curve. Okay, look at your AR curve. This split is called as a kink. The AR curve is not declining continuously. There is a break. There is a split at point P. This split is referred to as a kink. What does it tell? It talks about a feature called as price rigidity. Now, this price OP is said to be a price which will stay in the market for long. Why? Why is that we are not able to raise the price above OP? Why is that we are not able to lower the price? That is what is told. We are not able to raise the price above or below. Why can be understood from kinked demand curve. Students, am I audible? This is a very important segment. Are you able to hear what I am saying?
Yes, ma'am, audible.
Yeah, please understand this. I will wind up with oligopoly if you are too tired. I want to force economies of scale. We'll see. Okay, so this please look at this only, listen to it very carefully. The significance of kink demand curve. Now what is a kink? It's a split break in your demand curve or AR curve. Now supposing having fixed the price at OP, supposing you want to go for a higher price above OP, what will happen above this P line? Look at the shape of the demand curve. When one of the firm is raising the price above the OP price, then what will happen is other firms will not raise the price. So what is happening? All the customers of this firm will go to the other firm. Why? Because there are other companies to offer products. Though they are few, they are there, no? So this reflects the elastic demand curve. This portion depicts the elastic demand curve. We already saw, no, in monopolistic competition also I told you, flatter implies elastic, steeper implies inelastic. Remember that, okay? Now what happens here? Now when the price is raised by one firm, say a firm X in an oligopoly market raises the price above the P. Now what will happen? The people, other rivals will not raise the price. Now what will happen? The customers of company X will switch over to the other firms who have not raised the price. So you cannot raise the price. If you are raising the price, you will find elastic demand, all of them moving away. Okay, then why not lower the price? If you ask the question, why not lower the price? Let me lower it below P. What will happen? When X firm lowers the price before P, all others will lower. All others will lower. So what will happen? There will be no change in them because this firm X expected that I am lowering the price. Therefore, other firms' customers will come to me. It will be thinking. But what happened? Nobody followed it. Everybody followed it. Everybody is lowering the price. So when you do rise in price, rivals are not following. Rivals are not raising the price. When you lower the price, all of them are lowering. So when everybody lowered, see there is no change in your demand curve, which is defined as inelastic portion. So your dp reflects inelastic portion, your this dp reflects, small dp reflects elastic portion. Have you all understood, students? To explain that only, you have this kinked demand phenomenon. And here in kinked demand, when your AR is split like this, what happens to MR is what I have shown here. MR will become discontinuous. So in the as far as AR is elastic, MR will be sloping downwards. When there is a kink, AR breaks, MR splits. MR break, there is a gap. And the gap is shown by the portion AB. Right? And after that, look at MR, it's coming down, it is cutting the x-axis and going further. So when the demand curve is elastic, MR is positive. When the demand curve is less elastic or inelastic, MR is negative. Okay, the gap is the discontinuity in the MR curve. It's represented by the vertical line AB. Is that clear? So when you are having a kinked AR curve, what will be your MR is shown here. And I explained to you what this kink implies. This is one firm raising the price above the fixed OP price. Nobody is rising. So all of them leave this firm, go to the other. When you lower the price, everybody lowers, and therefore no change in the demand of this firm because all others have also lowered. So it is inelastic. When this kink happens, MR becomes discontinuous. Discontinuity is represented. So earlier MR is positive, then it becomes negative. Is that clear? And finally we end this discussion mentioning the three important models from the examination point of view. See, oligopoly is an experimental model. So a lot of economists have experimented. So we are ending with three important models. Cournot's model, Stackelberg's model and Bertrand's model. Three important models. So in Cournot's model, the firm's control variable is output. How are they doing? They are not going into a price war. Rather, they are taking into account output, bringing about variations in the output and acting in the market. They are not colluding. They want to act independently. In Stackelberg's model, what happens? There is a leader who commits to a level of output before all other firms. And the others are expected to follow. The other firms are followers. Is that clear? So there is a leader and others are expected to follow. In Bertrand's model, what is the control variable? Price. So each firm will independently set the price to maximize the profit. So in Cournot's model, they will set the output independently. Control variable is output. In Bertrand's model, control variable is price. In Stackelberg's model, control variable is output, and there will be one leader who commits to it and others follow. Have you all understood, students? So with this, our oligopoly is over. Have you all understood kinked demand curve, types of oligopoly, indeterminate demand curve, the meaning of the term oligopoly? Are you clear? Now you have to tell me whether you need economies of scale or not. I am leaving it to your choice. Choice is yours. So you want this topic to be done today or should it be continued tomorrow? You please let me know.
Tomorrow, ma'am.
Tomorrow? Okay. Too much have been done today. So don't worry. Anyway, you have cooperated well. So tomorrow we will go with this. As we saw yesterday, no, we started with a numerical example and went on. So tomorrow we will discuss. We'll start with this segment and go on to the rest. Is that clear, students? Yes, have you all understood everything clearly? So did you follow this part which was suggested for you? Were you listening carefully, jotting down the core points, not chatting with another or disturbing another? So I'm sure you have all noted down the core points. Okay? So a glimpse of all these topics you've got, I believe and I trust you. Is that okay? So, shall we wind up now? There are happened to this? I wanted to show you all Shanti mantra, which always. Oh, did you all hear the Shanti mantra, students?
No, ma'am.
See whether you can hear now. While winding up, I will see whether you all can hear now.
Not able to hear, ma'am.
See here.
Not able to hear, ma'am.
चिदानन्दरूप शिवोऽहं शिवोऽहं
Not able to hear, ma'am.
Hello, ma'am. Hello.
चिदानन्दरूप
Hello.
शिवोऽहं
Excuse me, ma'am.
शिवोऽहं
Yes, tell me. Yes, somebody said excuse me. What do you want? Let me know. Hello. Are you there, students? Hello.
Ma'am.
Yeah, somebody asked something. What is that you want? So are we winding up, or you want economies of scale? Somebody already suggested we can do tomorrow. How about the others? I will get the collective opinion and we will decide. Tell me. Waiting for your response.
Can we continue tomorrow, ma'am?
Okay. Okay, done. So we will do it tomorrow, right? So whenever possible, when you have time, go through what's try to recollect what you have jotted down. Be sure that these lectures are getting uploaded. Probably we will post it in the Google Classroom. I think that's the method. So that's what we will do for you. And tomorrow, let me meet you all same time. By God's grace, at 9 p.m. we'll see.
Bye, ma'am.
Bye. Take care. Have a great evening. Thank you, dear.
Thank you,
Thank you, ma'am.
Thank you so much.